Okay, good morning, everybody. Both here physically in this ballroom, and also virtually, well, basically around the globe. It's a great pleasure to welcome you, everybody, to this 30th Anniversary Conference of BOFIT, Bank of Finland Institute for Emerging Economies. So my name is Iikka Korhonen, and I'm head of BOFIT. Before inviting Governor Olli Rehn to give the welcoming speech, just a few housekeeping matters. In all of the sessions, there will be a possibility to pose questions and/or comments. Here in the ballroom, there are microphones, and if and when the chair gives you the floor, you can walk up to the microphone, introduce yourself, and pose the question. Also, via chat, that is being moderated by our BOFIT colleagues, you can pose questions, and then this will be relayed here in the ballroom. We are also monitoring #BOFIT30 on Twitter. So if you have a question or a comment and you add that to your Twitter tweet, then that could be taken into account as well. But now, without further delay, I would like to invite Governor Olli Rehn to give his opening remarks to this conference. Olli, please.
Thank you, Iikka. Ladies and gentlemen, dear friends, today we are celebrating the 30th anniversary of the Bank of Finland Institute for Emerging Economies, or BOFIT as it is often known. The unit's name has changed a few times over the years, but the commitment to rigorous analysis and research on large emerging economies has been maintained throughout. In these opening remarks, I would like to discuss the origins of BOFIT, as well as how this history reflects changes in the global economy, transformation in the global economy, and Finland's changing trade patterns. In the future as well, we shall need analysis of global phenomena even more than we do today. I think it's not an exaggeration to say that 3 decades ago, the geopolitical and economic tectonic plates were rapidly shifting in Europe and elsewhere in the world. The disintegration of the Soviet bloc had begun in 1989, and more and more countries were abandoning the centrally planned economic model. The Berlin Wall fell in November 1989, as we know. However, exactly 30 years ago, the Soviet Union still existed. Economic relations between the Soviet Union and Finland were based on a barter trade arrangement. That means that every year the value of goods exported from Finland to the Soviet Union was supposed to match the value of goods imported from the Soviet Union to Finland, more or less. Based on the logic of the centrally planned Soviet system, companies did not deal directly with each other. Instead, the respective governments agreed on what was bought and sold, and also at what price. More importantly, from the point of view of the anniversary conference today, payments flowed through the central banks of the 2 countries. Hence, the Bank of Finland had a whole department dealing with payments to and from the Soviet Union, and also various economic risks arising from such payments. Experts from this department also participated in successive rounds of trade negotiations. However, especially in the 1980s, there was a growing realization that the various reforms initiated in the Soviet Union could have far-reaching consequences for the whole Soviet economy and society. Economists at the bilateral trade department began to pay more and more attention to the Soviet reforms and their potential effects, potential ramifications. By 1990, if not already earlier, it had become obvious that the Soviet reforms and general economic disintegration had proceeded so far that the old system of trading would have to be abandoned. This also meant that the raison d'etre, the old raison d'etre of the bilateral trade department was rapidly fading. At that stage, the board of the Bank of Finland started discussions internally and with other stakeholders concerning how to preserve the analytical capabilities of the department. The late Matti Vanhala, a former governor of the Bank of Finland, in particular stressed the need to understand economic developments in Finland's large eastern neighbor, also in the new and emerging circumstances. In fact, we can say that Finland always has a vital national interest in analytically comprehending, understanding its eastern neighbor, from geopolitics and history to its economy, trade and society. Moreover, Matti Vanhala, who was responsible for the bilateral trade department at the time, already had the idea that such analytical capabilities would be of benefit to Russian policymakers, especially the reformers, and also other European policymakers. In fact, cooperation at the European level has been one of the strengths of BOFIT's work over the years. Come May 1991, it was decided to disband the old department and establish a new unit specializing in analysis of the Soviet economy. Just after the unit for Eastern European economies had begun its work on September 1st, 1991, the main object of its study, the Soviet Union, ceased to exist. But the arguments for understanding the economic developments and their underpinnings in the society in our large neighbor were and obviously remain still true, even if the neighbor is now called the Russian Federation, or has been for quite some time already called the Russian Federation. However, it is noteworthy that dissolution of the Soviet Union also meant that the three Baltic states were able to regain their independence, a process that had begun in the 1980s through the singing revolution, as we know from Estonia, and other equivalent phenomena in Latvia and Lithuania. The new unit would analyze the Baltic economies up to their membership in the European Union in 2004. And we can note that the late member of the Bank of Finland board, Esko Ollila, a long-time and well-known Estophile, was indeed instrumental in forging many of the institutional ties between the Estonian Central Bank and the Bank of Finland. My Estonian friends at the Eesti Bank often say that if I visit Tallinn, they say that if you see any faults or system errors at the Eesti Bank, blame yourself because it was Esko Ollila and the Bank of Finland who were instrumental in supporting the creation and development of Eesti Bank in the 1990s. Currently, the majority of BOFIT activities concern two large emerging economies, namely China and Russia. The emergence of China as the world's largest exporter and the second largest economy has been first a gradual and then intensifying epoch-making tectonic shift in the global economy during the past 4 decades. The Bank of Finland hired its first China economist already in the late 1990s, in 1999, well before China joined the World Trade Organization and before China started to really affect the global trading system and also production in other countries. Many of the recent analyses of BOFIT and the Bank of Finland more widely have looked into the functioning of global production networks and world trade. China is obviously a very important player in global and regional production networks, but also production chains in Europe and Northern America remain vibrant. And despite the current problems with shipping and other logistics and production bottlenecks, shortages, our analysis clearly shows that globalization has not been cancelled. In fact, this year the volume of international trade will reach an all-time high, which may come as a surprise for many because of taking into account the COVID-19 pandemic and the economic difficulties we have all faced. As the center of gravity of the global economy continues to shift away from the Northern Atlantic, analytical skills and traditions in doing research on faster-growing emerging economies are ever more important for understanding our world. Nevertheless, it would be wrong to claim that all is well in the global economy. Once the current hiccups related to the uneven COVID recovery are past, we will not return to the same situation that existed previously. We will not return to a situation with only minor trade frictions. It is obvious that now and also in the future, our global economy continues to be marked by very intense and tense great power competition in innovation, in technology, in business, in many, many sectors. This competition can sometimes take the guise of a trade war, as when the US imposed tariffs on Chinese imports. But perhaps even more significantly and profoundly, competition is felt in the fields of technology and science. Nevertheless, we have all the reason to hope that there is enough sense of international responsibility and cooperation in the ongoing COP26 climate conference in Glasgow to help the world avoid an environmental crisis or an even more serious environmental crisis we are already in. In the current vacuum of global cooperation, the central banks are an exception. In spite of all the ongoing global tensions and the return of power politics, international policy cooperation among the central banks is very much alive and functioning. It was crucial, it was instrumental in sparing the world from a new recession or even depression when the COVID pandemic hit the world 20 months ago. The rapid and forceful action and monetary stimulus, especially by the Federal Reserve and the European Central Bank, has supported the economy over the troubled waters. And all through the crisis, cooperation with the People's Bank of China and the Bank of Russia has been also very good at all levels, and I want to thank both central banks for this constructive cooperation. Our intention is to keep it that way also in the future. So, dear friends, with these words, I would like to welcome you to BOFIT's 30th Anniversary Conference. I hope the discussions and presentations, both in physical form here in Helsinki at the former headquarters of State Railways and virtually online, will help us in deepening our understanding of the global economy, including the dynamics that are driving the current great power competition, which always also matters to small countries like Finland. Thank you very much for your attention and warmly welcome to this conference.
Yes, please. Please go ahead. So now it's time for the panel. And I think we should have also Governor Elvira Nabiullina online currently. So please, Olli and Fabio, please.
I need the remote control for the slides.
Can you use that?
This one?
Green is
okay.
And the other one I can.
No, thank you. Good morning, everybody. And let me start by thanking the Bank of Finland and in particular Governor Olli Rehn for inviting me to participate to this panel on the occasion of the 30th anniversary of the Bank of Finland Institute for Emerging Economies. It's a pleasure to be here and to share our views on CBDCs in general and more specifically on our project on a digital euro. I would say a few words to describe the main characteristics of the digital euro project, leaving further comments for the Q&A session. And let me say up front that the digital euro project is a common euro system project involving the European Central Bank and all 19 national central banks. Among them, the Bank of Finland, which is playing a major role leveraging on its excellent understanding of digital issues in general and of payments in particular. Okay, so first of all, let me recall the focus of the digital euro project. The digital euro would be a central bank liability, so central bank money, available in digital form for use in retail payments. The main objective of the project would be to maintain public access and full usability of central bank money as consumers and firms turn more and more to electronic payments. With this overarching objective in mind, let me discuss in more detail the policy objectives and the scenarios that motivate our work on a digital euro. The ultimate objective of the digital euro project is to maintain the crucial role of central bank money in the economy and to preserve its role as an anchor of the payment system. And let me explain in some detail what I mean by this. Today, we all use private money in our everyday life. Why do we accept, without any problem, that private money? We accept it because we know that it is convertible one-to-one with the safest form of money in the economy, public money, central bank money. One-to-one convertibility with risk-free central bank money gives to all of us the necessary and sufficient information to infer the value of private money. After all, if we can convert private money one-to-one into riskless public money, we don't need to monitor the soundness of issuers of private money. For example, in order to infer the value of our bank deposits, all we need to do is to go to an ATM and transform our deposits into an equivalent sum of cash. In this sense, central bank money available to the public, today this means cash, banknotes, represents the anchor of the payment system, the metric for the value of private money. If riskless central bank money were not available, that is, if we were without a monetary anchor did not exist, in order to infer the value of different forms of private money, we might have to engage in costly monitoring activities. In this situation, a crisis would sooner or later lead to the emergence of an exchange rate among different forms of private money. This would undermine the singleness of the currency. As we know from history, from the periods of free banking that prevailed in a number of countries in the 18th and 19th century, situations in which private money coexisted without the availability of public money ended in recurrent, frequent crises, which in the end undermined trust in money. So, but the problem then becomes, why do we need a central bank digital currency if we have cash? After all, cash is already playing the role of anchor of the payment system. The problem is that the role of cash, as we all know, is declining. Citizens increasingly pay digitally and shop online. If this trend continues, cash will lose relevance and might even become a marginal means of payment that people might become reluctant to accept. Why? Well, because they might be unable to use cash. For example, in a world that is 100% digital, cash would be useless, just like a postage stamp after the advent of emails. In some countries, and Finland is among them, the use of cash is already declining very rapidly. And we cannot exclude nonlinearities in cash usage. In fact, the pandemic has accelerated the use of cashless means of payment. So the ECB intends to preserve access to cash, but at the same time, we need to ensure that central bank money would still play the role of anchor at times when payments go digital. And this is the main motivation of our work on a digital euro. Let me now describe the investigation phase of our digital euro project that we have launched last October. The Governing Council has approved this step of the project last October. The investigation phase will last 24 months. And during these 24 months, we will examine first the use cases of a digital euro, whether it would be person-to-person, business-to-person, whether it would be for domestic versus cross-border use, etc. Second, we will examine the interaction with the European retail payments market. Of course, we want to build a digital euro which will be fully interoperable with private means of payments, otherwise it would be less useful than we intend it to be. Third, we will examine the business model for remuneration and distribution. I will say more on this later. Fourth, we'll examine the features and functionalities. For example, whether it would be only online or also offline, how to guarantee confidentiality, privacy. We will then examine the legal basis, including the possibility that a digital euro would be legal tender. This should not be taken for granted, even though it's a likely outcome, and this will be examined in the next 24 months. And finally, we will examine the technical solutions that could best handle these issues, whether we would have a centralized versus decentralized technology and associated problems. The identification of payment segments and design decisions will naturally come first. Technological solutions and legal choices should follow. So the first step would be to understand the optimal design of a digital euro and then adapt the legislation and the technology to deliver on the optimal characteristics. We expect to narrow down the design-related decisions by the beginning of 2023 and to develop a prototype by mid-2023. So this is indeed an ambitious timeline. Other central banks have started to work on their respective digital currency long before the euro system. Sweden, China, and they are still working because this is a very complex project. And the central bank is a very peculiar institution. We cannot offer a product that is not working 100%. We are not a startup company that offers a product. If it doesn't work, we offer another one. We will only launch a digital euro if we are 100% sure that it will serve the needs of European citizens. During the investigation phase, we will cooperate and interact with multiple stakeholders. We are already cooperating with EU policymakers and co-legislators on major design and policy-relevant issues. And of course, a broad political consensus will be essential to ensure the success of a digital euro. We will need to implement legislative changes. We will have to take into account how to address fundamental rights like the right to confidentiality. So there is a need to involve the political dimension and to have the support of public opinion at large. The co-legislators will discuss the legislative changes that may be necessary, considering the design options that we will identify. On the user side, we have established focus groups to explore citizens' and merchants' preferences and experiences. So what is a focus group? A focus group is a group interview involving a small number of participants with specific characteristics. We will use the focus groups to better understand people's preferences and reaction to services. We do want to offer something that is useful for the people, and we would really want to understand their preferences and their needs. We are working with the industry in the context of the Market Advisory Group and the European Retail Payments Board. What are these two bodies? The European Retail Payments Board is the strategic body in charge of fostering the integration, innovation, and competitiveness of retail payments in the European Union. It's established at the European Central Bank, and I have the pleasure to chair it. The Market Advisory Group is a group of experts, industry experts from intermediaries that are involved in offering payment services, banks, payment companies. The Market Advisory Group will advise the Euro system on the distribution and design of a digital euro from the perspective of the industry. And finally, close interactions with other central banks working on CBDC will help us exchange experiences and discuss technical solution for a possible use of a digital euro across borders and currencies. Now, a crucial question for a central bank is how a digital euro and central bank digital currencies in general will affect monetary policy. The ECB's primary mandate to safeguard price stability would not be affected by the introduction of a digital euro. On the contrary, as I mentioned before, by providing a monetary anchor, A digital euro would play a key role in maintaining a well-functioning payment system and ultimately trust in the currency. This, in turn, is a precondition for preserving the transmission of monetary policy and hence for protecting the value of money. Likewise, a digital euro will be designed in a way that does not interfere with the transmission of monetary policy. In particular, any reflections on the introduction of CBDC must consider the potential implications for financial stability. Let me now come to the other big issue, financial stability. In theory, a digital currency could threaten financial stability. A significant shift from bank deposits to CBDCs, central bank digital currencies, could have implications for lending and intermediation by the banking sector, especially if such shift happens abruptly. In addition, a central bank digital currency could exacerbate run dynamics in crisis periods and the latent level of liquidity risk banks face. This risk is reduced in the existing system through effective banking regulation, deposit insurance, and capital requirements. At the same time, the introduction of a central bank digital currency has the potential to offer new opportunities for innovation, which may benefit banks and non-bank third-party providers of financial services, supporting a competitive financial system. For example, the introduction of a central bank digital currency could support innovative payment services such as lending to users, the availability of programmable payments, or information on the account statements by users. A central bank digital currency could also allow for more diverse forms of finance with less need to rely on centralized payment intermediation. This could be, for example, the case if the digital euro helps reduce the reliance on correspondent banking in international payments. In parallel, greater competition for deposits and lending could bring in new entrants and encourage expansion of non-banks. As a result, the resilience of the financial system would tend to increase overall, subject to robust prudential frameworks. Now, given the financial stability concerns, we are already actively discussing the safeguards that could mitigate the risks that could arise from the introduction of central bank digital currencies, from a digital euro. These safeguards can include various combinations of limits on individuals' CBDC holdings or transactions or remuneration options. One possibility is to introduce a quantity-based safeguard in order to restrict the use of CBDC, for example, through hard limits on the transfer or the holdings of CBDC. So the idea is that, especially in crisis times, depositors could choose to shift out of bank deposits into the digital euro. If this happens, then a digital euro will be facilitating digital runs. So we want to limit this possibility in order to avoid that this has a destabilizing effect on the financial system. Alternatively, we could introduce price-based safeguards in order to disincentivize large holdings of central bank digital currencies or large payments in central bank digital currency. We could consider paying uncompetitive interest rates on central bank digital currency holdings above a threshold to disincentivize use as a form of investment. Here, the logic would be different from the one I described before. You don't work through the imposition of constraints, but through incentives. There would be a tier 1 amount of CBDC which could be held by users, say up to 3,000–4,000 euros. Above that, you can still hold additional central bank digital currencies, but the remuneration is a penalizing one, a remuneration that disincentivizes the accumulation of large holdings of central bank digital currency. Why do we do this? Because we want to introduce a central bank digital currency as a means of payment and not as a store of value. So we do not want to offer an alternative way to invest your savings to existing forms, the existing options, such as bank deposits. Overall, the consideration of financial stability risk is at early stages and largely qualitative, but suggests somewhat limited or manageable impacts for a well-designed CBDC framework. So there are potential threats, but there are also solutions, and the discussion we are having is fully aware of the potential risks, and we are discussing the safeguards. I will stop here. Thank you.
Thank you, Fabio. Please have a seat. Many thanks for the very analytical and substantive introduction to this panel discussion. And we will return to these issues that Fabio raised in his presentation. Now the panel will continue with the presentation of Governor Elvira Nabiullina of the Bank of Russia. And by way of introduction, I could say that the Bank of Russia, which is known for its professionalism and preservation of price stability and financial stability in Russia, and modernization in the part of the banking and financial system, the Bank of Russia is also currently testing a central bank digital currency with a number of commercial banks, and Governor Nabiullina will discuss their next steps in this regard. So the floor is yours, Elvira. I hope we can hear you and see you. Please.
Good morning. First, I ought to thank the Governor Olli Rehn for the invitation and to congratulate the Bank of Finland and the Institute on this significant date. 3 decades is a weighty milestone. Created at the outset of the Eastern Europe's and Russia's transition to market economies, it became a truly major think tank on the economics of transition, and later on the subsequent development with particular focus on Russia and China. I am much delighted to have the opportunity to share the Russian perspective on arguably quite significant new transition, the one to the world where central bank digital currencies facilitate more advanced, but what is even more important to us, cheaper payment solutions for our citizens, and also carry the promise to simplify and accelerate the cross-border transactions in the longer run. The CBDC subject area covers a very broad turf. In this panel, we were asked to focus on 2 dimensions of the CBDC's agenda. First, to outline state of the play on the subject in our respective institutions. Second, to share a more general view on CBDC implications for the conduct of monetary policy. The Bank of Russia has always paid a lot of attention to the development of digital financial services, especially in payments. We started with national payment system and then introduced fast payment system, which is quite popular among Russians now. Russian banks themselves showed high capacity of creating digital solutions and encouraging people to use it. Nowadays, Russia has really high level of digital finance. Literally every bank customer in Russia uses online banking. Most banking, insurance, and investment products can be purchased online. In payments, cash operations are now less than 30%. We started to contemplate on CBDC in 2018, and then we had some reservations. Can it add real value to customers relative to other digital services? But analyzing all the pros and cons, considering the experience of our colleagues, especially from China, we decided that we should seriously explore the prospect of digital ruble. We reached the decision to explore the possibility of the digital ruble last year. Our consultation paper, published in October 2020, outlined the motivation and the fairly long list of questions to gather feedback and opinions from the financial sector and other stakeholders. In April, we published the digital ruble concept document with the outline of the digital ruble's principal architecture. In our design, the digital ruble is a retail CBDC. The digital ruble is the direct claim of the holder on the central bank. All individual electronic wallets for the digital ruble are opened on the Bank of Russia balance sheet and in the centralized ledger maintained by the Bank of Russia. The banks and other financial intermediaries carry out all direct client interactions, including KYC procedures, and provide access to customer digital wallets through their applications. The design is our answer to a crucial trade-off. The BIS paper by Auer and Burma, CBDC, the quest for minimally invasive technology, published this June, defines this as the trade-off between the complexity and reliability of technical infrastructure on the one hand, and the complexity and robustness of the supervisory regime for the CBDC on the other. We judged that in our case, the complexity of the technical infrastructure will be easier to negotiate than the comprehensive and robust supervision. I also want to say a few words on the key design consideration, the dichotomy between account-based versus token-based designs for the CBDC. We know that anti-money laundering CFT demands mean that a cash-like anonymity is not an option for the CBDC design. We shall also keep in mind that the flip side of anonymity is a much greater exposure to fraud of all sorts. The digital ruble wallets will be linked to identities of their owners. Thus, from the standpoint of access mechanics, this clearly fits the definition of an account-based system. That means I'm the owner of the account, therefore I own. The token-based access is described by the formula, I know the key or to an anonymous account, therefore I own. But the currency in these account-based wallets may be tokenized. That is, it will consist of individual distinguishable units. By analogy, one can think of this approach as of an electronic equivalent of a usual wallet holding individual banknotes, which are de facto tokens. But the wallet itself is monogrammed. The IDs of the owner can be ascertained. Each such electronic banknote token then retains a mark identifying the chain of the wallets in which it resided in the past. Possibly also carries other properties. This shall facilitate the novel features related to traceability of money flow or programmability of their use. One possible example, just to give a sense of what I mean under programmability, say a banknote may be marked with a property that its current owner shall spend it only on specific medicines or alternatively on back-to-school items. This also will greatly enhance the ability of the government to provide targeted social transfers, ensuring that the money are spent for desired purposes. Once this conditioning or program is fulfilled, this special purpose flag is annulled and it becomes part of the homogeneous money. The exact scope of such user cases is yet to be explored, but conceptually, it will be part of the digital rubles design as we conceive it today. And the third detail about the digital ruble design, which I want to highlight, is the matter of remuneration of the CBDC balances. That is whether the central bank accrues interest on the CBDC. In most white papers of the other central banks, this is stipulated as an open question to be decided. But the tone of the discourse seems to lean towards the designs which permit, at least in principle, accrual of interest or payment of interest by CBDC holders to the central bank if the policy rate is less than 0. The literature, both by the central banks themselves and by academia, sees this approach with interest-bearing CBDC as strengthening the role of the CBDC as the monetary policy transmission tool. And for those central banks which already have negative or 0 policy rates, charging the same interest on the CBDC is in fact the maybe only permissible option. Meanwhile, we at the Bank of Russia very strongly agree with the thesis stated in the already cited paper by Auer and Böhme, the thesis that economic design should emphasize the use of the CBDC as medium of exchange, but needs to limit its appeal as a savings vehicle, as Fabio mentioned already. With that in mind, the Bank of Russia made a definitive decision that the digital ruble will not be interest-bearing. In our view, this is the easiest way to draw the hard line between the medium of exchange and the means of saving functions for the CBDC, and avoid competition between the CBDC and the bank money in the savings space. Where the digital ruble will compete with the bank money is at the medium of exchange. And this takes me back to our motivation for the digital ruble, why we decided to seriously explore the possibility of its launch. In the last few years, there has been a tremendous growth in the use of electronic retail payments in Russia. In fact, it was much faster than we could imagine, say, 7 or even 5 years ago. And the pandemic has accelerated this process. But this payment remains fairly expensive for businesses, especially small and micro-sized merchants and consumers, even if consumers do not fully appreciate the costs passed on them by merchants. We expect that the introduction of the CBDC as a very basic but cheap payments platform will present a credible threat to the banking sector's monopoly on electronic payments. And we expect that in response to this credible threat, the banks will lower their commissions and probably will also offer high interest on transaction balances to retain those money on their balance sheets. Therefore, as the measure of success of the digital ruble project will be not the amount of digital rubles in circulation, but a notable improvement of terms of service for the bank customers. This naturally takes me to the second topic, the CBDC effects on the conduct of the monetary policy. In the interest of time, and given that Fabio already flagged many of the key points in his presentation, I will address it with the non-interest-bearing design of the digital ruble in mind. In a nutshell, the non-interest-bearing design makes the CBDC economically nearly identical to the physical cash, banknotes and coins in circulation. Thus, the movement of funds between the bank money and the CBDC becomes a factor influencing the liquidity balance of the banking system. And here we should differentiate between two effects. First, the structural shift in the liquidity distribution between forms of money. And second, the day-to-day flows of liquidity between the bank money and two other forms of central bank monies. On the structural shift side, I want to draw on the earlier point that we shall think about it with the banking sector response in mind. The transaction balances is the cheapest source of bank funding. Banks will strive to retain them, even if it comes as a high price. Some outflow into the CBDC will occur, but I would not expect it to be a major shift, especially if the CBDC does not have the degree of anonymity comparable to cash, which is maybe a major attraction of banknotes these days. On the other hand, I agree that with respect to the cross-border payments, the CBDC may offer a better level of convenience than existing retail payment solutions. But of course, the bank's cost of funding will increase somewhat compared to the equilibrium without the CBDC form of money. We and other central banks will have to take this into account when evaluating monetary policy transmission mechanism. This is one of the reasons for a staggered process of the CBDC introduction, so that both the banks and the regulator have time for this evaluation and appropriate adjustments. As for the day-to-day flows to and from the CBDC in the normal times, this shall not be different from managing the flows to and from physical cash. This is something which is fully accounted for in the monetary policy implementation today. However, in the event of financial stress, namely a bank run, the CBDC provides a much more convenient and readily available instrument for flight to safety than physical cash. You can make this transfer at a click of a button rather than queuing to a cashier window or to an ATM. In order to avoid a rapid conversion of the bank money to the CBDC in such circumstances, a gating, that is some sort of maximum limits on the amount which a person can move from the bank account into the CBDC in a given day, may be advisable. Another option is to set a cap on the amount of funds which can be stored in each wallet. One can think of other forms of such speed limits on the base of withdrawals into the CBDC. We are yet at an early stage of reviewing these options and will do it with care. To conclude, a few words on the way forward. We expect to have a prototype of the digital ruble platform in the beginning of the next year. This will allow us to commence piloting it in 2022. It will be a multi-round exercise and will last as long as required to test and refine all aspects of the digital ruble use, life cycle, incident resolution. Once the piloting is completed, to our and other stakeholders' satisfaction, the final decision on the introduction of the digital ruble will be made. Of course, we look forward to carefully watch and study the experience of those colleagues which go ahead of us, namely the People Banks of China. I'll stop here. Thank you for your attention.
Thank you so much, Elvira. Many thanks to Governor Elvira Nabiullina for this very enlightening and indeed clear and fascinating presentation. I bet we have many follow-up questions, but before we enter discussion and panel discussion and Q&A, next we move to Beijing virtually, and Governor of the People's Bank of China, Yi Gang, will participate with a pre-recorded presentation, as he has at this very moment something else to do. He is participating in the plenum of the Central Committee of the Chinese Communist Party, which is a rather significant global event. China has progressed quite far in piloting its digital central bank currency, with more than 120 million people signed up for testing already. Therefore, the Chinese experience is indeed very interesting and important also for other central banks, other financial systems, other payment systems. So without further ado, now we give the floor to Governor Yi Gang of the People's Bank of China.
Ladies and gentlemen, distinguished guests, greetings to all of you. First, I would like to convey my sincere congratulations on the 30th anniversary of the Institute for Emerging Economies of the Bank of Finland. I also like to thank Governor Olli Rehn for inviting me to discuss the important topic on central bank digital currencies. I'd like to briefly introduce the progress of eCNY, how we deal with privacy protection and financial stability, and finally, a few words on the next steps. On the progress of eCNY, which is CBDC in China. In recent years, we've seen fast development in electronic payment in the world. The trend is more during the COVID-19. Last year, mobile payment in China increased by 25%, with a penetration rate of 86%, which greatly helped facilitate people's daily life. However, mobile payment services are mainly provided by private sector, brewing risks of market fragmentation and privacy infringement. CBDC allows central banks to continue to provide credible and secure means of payment in digital era, while improvement of efficiency and integrity of the payment system. At present, over 110 countries are at some stage of exploring CBDC. For China, the main purpose is to meet the need of domestic retail payment and improve financial inclusion. The People's Bank of China started to study digital fiat currency in 2014 and developed a proof of concept in 2016. From 2017, we cooperated with commercial banks and internet companies to conduct eCNY R&D project. Since late 2019, eCNY pilot have been launched in 10 cities, and the 2022 Beijing Winter Olympics. In July this year, we released the eCNY white paper. As of October, pilot scenarios have exceeded 3.5 million, over 123 million personal wallets have been opened, with transaction volume totaled renminbi 56 billion yuan. eCNY scenarios are wide-ranging, including green transactions to support carbon reduction. Going forward, we will continue to prudently advance R&D of eCNY, improve its design and use. Efforts will be made to establish a management model with reference to cash and bank accounts. Enhance efficiency, privacy protection, and anti-counterfeit features. Increase interoperability with existing payment tools, and improve the eCNY ecosystem. On CBDC's implications for financial stability and privacy protection, CBDC impact on monetary policy and financial stability mainly depends on the design. If a CBDC is more like cash, the impact would be relatively limited. If a CBDC has the attributes of deposit and other financial assets, deposit substitution is likely, which could lead to disintermediation and less efficient monetary policy transmission. We have explored how to reduce the negative impact. First, eCNY is positioned as M0 and bears no interest to reduce competition with banks for deposits. Second, eCNY adopts a two-tier system where the central bank is at the core to control issuance, and commercial banks and payment institutions act as intermediaries to provide exchange and payment services. Third, we have introduced some frictions such as upper limit of wallet balance and transaction amount to minimize the risk of bank runs. We also aim to test eCNY's impact on monetary policy and the financial markets in the pilot. A delicate balance needs to be made between privacy protection and crime prevention. It is an international consensus that CBDC cannot be completely anonymous. Then comes a question: would central bank have too much information at its control? We attach great importance to protection of personal information. eCNY follows the principle of anonymous for small value and traceable for large value transactions. Information is collected in the principle of minimal and necessary, which is less than collected by existing electronic payment instruments. The People's Bank of China mustn't hand over information to third parties or other government agencies unless otherwise stipulated in laws and regulations. China has recently introduced the Data Security Law and the Personal Information Protection Law to strengthen privacy protection. Finally, on the way forward, we have always stressed that use of eCNY should be market-oriented. In other words, we will issue as much as eCNY as consumers need. China has a vast territory, a large population, and a diverging regional development. Cash will not demise in the foreseeable future. As long as there is a demand for cash, we will continue to supply cash. Cross-border use of CBDC involves more complicated issues such as anti-money laundering and consumer due diligence. Therefore, eCNY focus on domestic retail payment at this stage. We would like to strengthen cooperation with other central banks and international organizations on CBDC. The People's Bank of China, the BIS, the Bank of Thailand, the central banks of UAE, and the Hong Kong Monetary Authority jointly launched the multilateral CBDC Bridge project to explore the role of CBDC in cross-border payment. We also have regular technical exchange with the ECB. Going forward, PBOC will continue to study the standards and the rules governing CBDCs in an open-minded and inclusive manner in order to promote the development of international monetary system while addressing potential challenges. I wish this conference a great success Thank you very much.
Thank you so much, Governor Yi Gang, for the very enlightening and informative presentation, which very clearly shows that the People's Bank of China is in the avant-garde and is moving rather fast and consistently with the CBDC or the digital renminbi project. Now I would like to start this panel discussion or dialogue by asking Fabio and Elvira if they have comments to the presentations so far, and maybe we kick off with Fabio. Are you concerned about China and Russia moving forward faster than the Eurosystem? And do you see differences in the motivation of different central banks?
Well, let me say up front that after hearing the comments by Governor Nabiullina and Governor Yi, I feel reassured because I have been confirmed that central banks that are at the frontier in thinking on CBDCs have similar similar objectives, have similar views. I think it was a common view that CBDC should be a means of payment, not a store of value, not an additional form of investment. It would be a means of payment that should provide an efficient, cheap, reliable alternative to existing means of payment, a digital means of payment offered by private companies, not to replace them, but to add to the existing options. It is necessary for central banks to protect their core business, if I can call it this way, that is monetary policy implementation, and to protect financial stability. This is not intended to crowd out banks, to replace existing financial intermediation. This is providing an additional product that intermediaries themselves could use to build on top of it efficient, innovative services. So this is a common view, and I feel reassured. The CBDC is viewed, I understand from the comments by Governor Nabiullina, Governor Yi, as a step in a step towards technological progress. The central banks have stimulated innovation in the past in payments in the financial system at large, and they are doing the same now in the digital revolution. And another comment that I think is very important is that it is clear from this discussion why we are actively cooperating in different ways, in different formats, in different dimensions internationally. Because I'm very happy that our Russian and Chinese colleagues are ahead of the curve, because we can learn from them. We have regular exchanges at the BIS, in other international fora, bilateral exchanges in which we learn from each other's experience, and this is mutually beneficial. So I think this is, the comments I heard today are reassuring.
Thank you, Fabio. I would like to ask Governor Elvira Nabiullina if she has some comments on the presentations so far, and how do you see? Maybe ask also how do you see the value of international cooperation, for instance, in the context of the Bank for International Settlements, BIS, in this regard. So please, Elvira.
Thank you very, very much. I agree with Fabio that there are many similarities among our approaches. And I would like to stress on the fact that Fabio also stressed it. Only if central bank is 100% sure of the reliability of readiness in all aspects, technical aspects, cybersecurity aspects, KYC aspects, banking implication, financial stability implications, protection of personal data, etc. Only then it could be launched, because money is so important for the society. That's why it's very complicated project, and we should discuss carefully all the aspects. And of course, the cross-border issue, international issue, is very important. And we see it as one of the advantages for our citizens, for our businesses from this project of CBDC. And I think we should cooperate more in this initial phase, and while we design our national CBDCs, we should think that how in the future our national platforms will be connected with other platforms of the national CBDCs in other countries, because this aspect is very important. BIS now considers different options for that, maybe 3 scenarios with single standards, with single platforms and others. But I think we should accelerate this work, because it's too important for our internal work and to provide more opportunities for our citizens and for our businesses. Thank you. I will stop here.
Thank you, Elvira. I couldn't agree more. It's indeed crucial that we would have interoperability, and preferably as soon as possible, because we all are developing our own alternatives, our own solutions of central bank digital currency. Now I would like to ask if there are some questions from the audience, either present here or online. I think Ika is monitoring the chat online questions, but I wonder if there is a question by board member Tuomas Välimäki of the Bank of Finland. Tuomas, please, and the microphone is available here on your left.
Well, first, thank you all. Extremely important topic and interesting presentations. I have a question maybe to both Elvira and Fabio. Do you envisage that digital or CBDC should have a legal tender status with mandatory merchant acceptance, or will there be enough demand for public digital money instead of the current commercial digital money, even without the legal mandatority? Thanks.
Thank you, Tuomas. I might add that Tuomas has been a member of the high-level working group of the Eurosystem of all the 19 central banks of the Euro area and the European Central Bank, or in the reverse order maybe. And Fabio has been leading this work at the ECB. Perhaps could we start with you, Elvira? Governor Nabiullina, could you comment on this issue of legal tender that Tuomas posed?
We consider that digital ruble, our CBDC, will have the status of legal tender. It will be mandatory for merchants, for institutions to accept this. And we think it's very important to have this seamless conversion between different forms of money, to have this singleness of monetary policy system, of monetary space. I think it's crucial for the trust of the society to this money.
Thank you. How about you, Fabio? Please.
Well, I certainly agree with Governor Nabiullina. But I would add that the main objective should be that of guaranteeing that there is sufficient demand for, because the legal tender is a very powerful way of establishing the network effects which are necessary to establish a means of payment as a widely used means of payment. But you know, the legal tender would certainly help, but may not be enough. The experience we see with cash, which is legal tender, but it's not convenient anymore because many people, for example, shop online, and if you shop online, cash is not very useful. This experience suggests that legal tender is not sufficient. So from the comments we had before by me, by Governor Nabiullina, Governor Rehn, we are all very much focused in providing an efficient means of payment, which is attractive per se, which is convenient, which is a attractive alternative to existing means of payment. Then on top of this, the legal tender status, for me, sounds a natural choice because, you know, central banks already have means of payment that they are issuing, cash, which is legal tender. It would be quite awkward not to have legal tender status for an additional instrument issued by the central bank. But again, this would complement the attractiveness, the inherent efficiency of the instrument would not be sufficient per se.
Thank you, Fabio. Could I continue with one question, which is of interest for many of us here, I believe, and that is the impact on payment systems and, say, more broadly, the financial system. More specifically, even how are in your respective jurisdictions, how are the commercial banks approaching this matter? Are they frightened? Are they cooperative? Are they looking forward to it? Maybe Fabio, you might start.
Well, we had an attitude which has changed over time. The initial reaction was of concern, because the concern was that the central bank would step in with the power, the capacity, the resources of the central bank, providing a means of payment that could eventually become also a store of value that could crowd out the operations of banks. But then it took some time, and we are still in that business, to communicate that this is not the job of the central bank. This is not our objective. We want to expand the opportunities that people have in using digital means of payment. And as I tried to explain in my presentation, we need an anchor of the system. We need to provide a reference for inferring the value of digital means of payment. So we have to provide this for equilibrium reasons, but the intention is not that of crowding out banks. The intention is not that of replacing banks. By the way, I always mention a number. There are 2.3 million bank employees in the euro area and 60,000 central bankers. So there's no way we can replace banks. We can take over in providing the services that banks are providing today. This is not our job, this is not our intention, and we are now cooperating with banks, and the market advisory group, which I mentioned before, is precisely the way in which we are interacting with industry experts to learn from them how to make our digital euro interoperable with the front-end services that they are already providing to their customers. Because the value of a digital euro would be highest if it is fully interoperable with existing means of payment.
That's right, and that's also the tendency in the Nordic countries. Those who are not members of the euro are approaching the TIPS system, that is the European payment system, target instant payment system. Sweden is negotiating, Denmark has decided, and I would bet Norway will follow suit because that is paving the way for future interoperability in these areas. But please, Governor Nabiullina, could you comment on this?
In our case, the situation is similar. Banks were somewhat skeptical at the beginning, but we explained that we don't want to replace banks. We don't want to draw out banks. We need to cross maybe a crypto, not banks. But we know that banks are concerned with that because the competition, the commissions on transactions is one of the source of their profits, and but the technology gives us opportunity, gives the opportunity to provide the payment services for citizens and for businesses cheaper, faster, and we should use this opportunity through these central bank digital currencies. And of course, it will increase competition between banks for payment system, for providing payment services. But I think that the CBDC will encourage banks and to introduce more innovations on electronic financial services and the payments services. And I think that the main project, the main aim of this project is the public good, the good for citizens and for businesses. And banks, yes, of course, they will change, somehow adjust their business models. And that's why we will testing the CBDC and to align banks to have them the times to adjust their business models. That's it. Thank you.
Thank you, Elvira. Now we have some questions, I think, from the audience online, and Dr. Korhonen, Iikka, please, you may present those.
Okay, thank you very much. So I will actually combine two questions on basically dealing with the competition between digital central bank currencies and cryptocurrencies. So we have Xuan Fei from Beijing asking directly, how do you view the competition between private cryptocurrencies and digital central bank currencies? And then Arto Kovanen from Washington, D.C. asking whether, if there are problems and risks related to digital central bank currencies, would it be better just to regulate cryptocurrencies and establish sort of real-time settlement for those? So, thanks.
Thank you, Iikka. Governor Nabiullina, you already touched upon this. Maybe you could elaborate a bit further first. Elvira, please.
As for cryptocurrencies and stablecoins, at the Bank of Russia, we take a very cautious, I would say, rather suspect view on both of these types of private tokens. We see risks to financial stabilities from both of them, and we see that the entrance of cryptocurrencies, of global stablecoins, particularly global stablecoins to emerging markets, may increase currency substitution, crowding out fiat currencies. As a result, financial stability risks may increase, while monetary transmission mechanism may weaken. And that's why we think that digital CBDC is a proper solution to give people with what they need, cheap, reliable, with the protection of their personal data, solution for payments. And I think CBDC is the optimal solution for that. But for cryptocurrencies and stablecoins, we are very, very cautious. For example, we don't allow to use cryptocurrencies, private cryptocurrencies, in our payment system in Russia, and so on. Thank you.
Thank you. Fabio, please.
Well, it is true that we can improve remarkably the way we regulate crypto assets in general and stable coins in particular. Today, crypto assets in particular are largely used for criminal purposes. They are opaque, they give no guarantee to users. But it is true that could be fixed in some way. And also for global stablecoins or stablecoins in general, the regulation could be improved. But even if we do that, those instruments can never be money. Money must guarantee its value to users. You cannot have money that, any form of money whose value is 100 today, 105 tomorrow, and 95 the day after. That would undermine confidence into the currency. And even if you regulate as carefully as possible crypto assets and stable coins, you can never reach the objective of having the guarantee of the value that can be guaranteed only by state money, by public money. The only safe, truly 100% safe asset in the economy is central bank money. So there is no way we can replace cash, CBDC, with alternative instruments offered by the private sector. And as I tried to argue in my initial comment, you do need public money to guarantee the equilibrium of the payment system. The experience that many countries, the US, the UK, France, Italy, the experience of the past centuries is that in the absence of public money, the system has no equilibrium. And we would go through a sequence of episodes of instability in which, when a crisis emerges, people will start interrogating themselves on the value of their means of payment. Is this safe or not? In doubt, they could run. And this is precisely what happened in the past. This stopped with the introduction of sovereign money. 100 euros today, 100 ruble today is worth 100 ruble tomorrow or 100 euros tomorrow. No change. If you have a stable coin or a crypto asset, you cannot have that certainty. So the incentive to run in crisis situations would be just too high. So we have to guarantee the only truly riskless form of money, which is public money. So there's no substitution possible, even if you are very efficient in regulating those assets.
Thank you, Fabio. I wonder if there are further questions. Ilkka, please.
Okay, thank you. The chat has been very, very active, and again, I'm combining two questions. So, Professor Juha Junttila from Jyväskylä and then Dr. Umur Saglar. Actually, both are asking whether the digital central bank currencies could be a way for central banks also to give loans directly to customers. So, in this sense, infringe on commercial banks' business. If I'm paraphrasing correctly. Thank you.
Thank you, Ilkka. So far we've had some small talk and warm-up, and now we get to serious business. Fabio, maybe you start.
Yeah, this is the gentle way of asking this question, because I'm usually asked, are you going to do helicopter money? So, no, the answer is no. No, because this is not the mandate of the European Central Bank. We are not here to provide loans, paraphrasing a very famous sentence. This is not our task. And by the way, if the ECB wanted to give loans, we could already do it. We are not doing it, but we could do it just by crediting deposit accounts of citizens with central bank money. But we are not doing it, not because we cannot do it, because we do not want to do it, because it's not in our mandate. This is not the job of the central bank to provide loans to anybody except banks for monetary policy reasons. We are providing liquidity through banks for objectives that are of public interest, for monetary policy, for macroeconomic stabilization. We are not in the business of providing loans to individual citizens or companies.
Thank you. How about you, Governor Nabiullina? Elvira, please.
I could only agree. The CBDC for the payment is about the payment. It's not our mandate to give the loans directly to citizens and for business. Central banks conduct monetary policy. It's not our job. It's not our mandate, and banks can do it in a proper way.
Thank you, Elvira, for a very clear answer in this regard, as always. Now, are there further questions from the floor at this stage? Madame Newby, please.
Okay, so first of all, thank you for this excellent discussion. Very interesting views, and I've learned a lot indeed. So Governor Yikang said that the financial inclusion indeed is one of the big motivation behind the CDBC. But how to best ensure that the CDBC will benefit society as whole, all of its members? And just to note that even in European countries, there are huge differences in daily usage and access to internet. Thank you.
Thank you, Elisa. Could I turn to Governor Nabiullina? Elvira, please.
Okay, financial inclusion is a very important consideration in our policy. You know that for Russia it's the problem. We have quite a lot of remote small cities and villages. And we think that in general, digital financial services is a way to increase financial inclusion, and we see that people are ready to use these digital services if there is a connection to internet. And you are absolutely right. The access to internet is a very important element. That's why we consider offline CBDC, because it can work. It's technologically very difficult, but in principle, we can find the solutions how CBDC can work offline, even if the access to internet is temporarily non-existing, or you cannot reach immediately the zones with internet access. We consider this in the design of the CBDC from the point of view of financial inclusion, exactly. Thank you.
Thank you. Fabio, please.
Yeah, this is one of the important objectives of CBDC. In the euro area, we have a proportion of about 8% of citizens that are unbanked, with very large heterogeneity. In some countries, this proportion goes up to 20%. The introduction of a digital euro could help significantly in this respect. Why? Well, because it would be low cost. Today, we do not charge to provide cash. We will not charge to provide a CBDC. So it would be a low-cost digital means of payment. Today, we know that the use of privately issued means of payment is concentrated in high-income users. Low-income users use less digital payments because it is costly. This would not be the case for a digital euro. Then we would have the possibility to use the digital euro online and offline, which, again, if you are in a remote region and you don't have access and you don't have the possibility to connect to the internet, you can use it offline. We plan to make the digital euro available with different devices. You don't need to have a very costly smartphone. You may have a card with some safe means of identification, but that would be very useful for people that don't have the possibilities who cannot afford very, very costly means of payment. So overall, this is clearly one of the positive implications of issuing, because people already do have a costless means of payment, but it's very risky to hold in large quantities, which is cash. The homeless, they do have cash, but they get stolen quite often. While if you have a way of identifying your digital cash, and that cannot be stolen to you, and you can access it at low cost, then the situation would improve significantly.
Thank you, Fabio. That reminded me of a strange experience for me last week, 2 weeks ago. I have not been to the ATM for over a year. But as I was heading to Frankfurt and I was at the airport of Helsinki, I remembered, now please only take some cash. And I went to the ATM and drew some euros because if you go to Frankfurt, you never know if you can pay with your card in taxi. So better have some cash available. I have not used cash in Finland for over a year. It was actually quite handy because on Sunday I could pay for a Christmas calendar to a Girl Scout with a nice euro banknote. Very proud of myself. Now we are coming to the close of the panel, but we might still have, if Ika has one for the road, and then we conclude, please.
Yes, so actually we have a question from Olga Butorina from Russian Academy of Sciences. She's asking directly from Fabio Panetta, are there ways that the digital euro will foster the international role of the euro? But I think the same question can be asked from Governor Nabiullina as well. And Yigang mentioned in his speech that there are first steps to try to sort of make the SNY sort of more international usable. Thank you.
Thank you, Ika. Very important question. And if I could ask both Fabio and Elvira to say, take this as a final remark. So if you have something else to add, you feel free to do that. We start with Fabio, please.
Yes, potentially the introduction of a digital euro would support the international role of the euro. Why? Well, because to the extent that a digital euro would reduce transaction costs, the cost of payments, it would encourage billing in euros, and this would naturally stimulate the use of euros in international transactions. But let me say two things, two qualifications to this. First, it would be a temporary phenomenon, because in the steady state, when everybody will have a digital currency, if we have a digital ruble, a digital yuan, a digital dollar, a digital pound, and a digital euro, the advantage would not be there anymore, because it's in relative terms, of course. And second, we have some simulation which we have done on this specific topic, and the simulations are published in the 2021 ECB report on the international role of the euro, in which we simulate what would be the impact of the introduction of a digital euro on the international role of the euro, and the answer is there would be an impact. It's not going to be a game changer. In the simulations we published, the international role of the euro would increase from 30 to 35% of total global transactions. But it will not be a game changer, because in the end we know that the main determinants of the international role of a currency is the soundness of the economy, the quality of the institutions. There are other factors that are dominant, and then of course at the marginal level this would help until everybody has a digital currency, after which the advantage would, which is a relative competitive advantage, would naturally disappear.
Thank you, Fabio. Governor Nabiullina, please.
I think the international role of a sovereign currency mostly depends on the trust in this currency, in the soundness of the economy and its role in international trade. But the possibility to use sovereign currency in digital forms, I think it would increase attractiveness of this currency. But a lot depends on the future connectivity of different digital currencies. And the introduction of more convenient payment technology for a given currency may make it more attractive. And I think, in general, it's a positive factor for international role for this or that that currency. But Nevertheless, I think that sound policies, macroeconomic policies, monetary policy are more important than technology, and even digital technologies. That's why we should conduct our monetary policy in a very responsible way. But digital currency is a new opportunity for our economy and for our business. And I would like to thank you, Olli, and all the audience to inviting me and to hear the Russian experience on this important matter. Thank you very much.
Thank you, Elvira. And I would like to thank warmly Fabio Panetta and Governors Elvira Nabiullina and Yi Gang for their very valuable and valued contribution to this discussion. I'm sure the audience has really appreciated this and the opportunity to have dialogue with you. I believe I speak on behalf of all the participants. I would like to briefly sum up this panel discussion. We have had a glimpse or a foretaste of the future world of payments and financial system in 5 to 10 years of time, or 10 to 20 years of time. I think one takeaway is quite important, quite essential, and it is that the central banks are serious about a digital central bank currency. That's very obvious from the presentations of Fabio, Elvira, and Yi Gang. There will be a central bank digital currency. Some principles are already clear, others are still open and under discussion. Those that are clear, we can say that a CBDC would or will not replace physical cash, but it will supplement it. It will be created in cooperation with the commercial banks, not separate from commercial banks and the rest of the financial system. And its main motivation is to ensure faster, better, safe payments for citizens. Also, for many central banks, the motivation is financial inclusion, because in many countries this is a real issue, and therefore this can enhance the citizens' financial inclusion. At the same time, there are many open issues, and these open issues, of course, need to be resolved in the process of further preparing and then launching a CBDC. They relate to regulation, they relate to privacy, they relate to monetary policy, they relate to technology, cybersecurity. So these issues have to be resolved, and we in the central banking community are cooperating in this regard to find solutions to this. And finally, we also need to think about the international use of digital central bank currencies. As Governor Nabiullina said, interoperability is indeed essential, and that's why we are cooperating, for instance, through the Bank of International Settlements and other fora, and also bilaterally, so that we would be able to solve these issues and say before launching the CBDCs, we would be prepared in terms of interoperability. So this underlines the paramount importance of international policy cooperation in finance, in global central banking, and of course beyond that. So once more, warmly thanks to Elvira, to Fabio, and to Yi Gang, and to all of you. And with these words, this panel discussion is concluded. Thank you, and have a good day in Moscow.
Thank you for the invitation. Thank you. Pleasure to be here.
Thank you, Fabio. Ciao.
Okay, thank you very much, panelists. Now we break for roughly half an hour, So we reconvene at 11:45 Helsinki time, or 12:45 in Moscow, or 10:45 in Frankfurt and Brussels. Those of us who are here in Helsinki in the ballroom will have coffee in the same place we had breakfast. Those of you who are in the office or home, you have to fend yourselves, and hopefully you find your favorite beverage, whatever it might be. So we'll see you in about 25 minutes. Thank you.
Ladies and gentlemen, dear colleagues and friends, after the excellent panel on central bank digital currencies and their policy implications, it's time to slightly shift the focus of the conference. We'll next have the keynote address by Erik Berglöf, the chief economist of the Asian Infrastructure Investment Bank. In his talk, Erik will tie together two other extremely topical issues. Namely, he will be discussing on global value chains and their role in the transition to net zero carbon emissions. But before that, let me also congratulate the Bank of Finland Institute for Economies in for Emerging Economies, BOFIT, on its 30th anniversary. As the Bank of Finland board member responsible for research, it's been gratifying to see our research and analysis on large emerging market countries to grow and thrive. I took it as a great sign of appreciation to the working of BOFIT when I this morning started reading the largest newspaper in Finland and saw its editorial praising the impact the BOFIT has had on broadening our understanding on the functioning of the Russian economy. I believe the editorial was about Russia only, as it's needless to say, spell out how important the working of the BOFIT has been as the leading Eurosystem research unit on Chinese economy. Moreover, the program and audience of this anniversary conference are testimonial to BOFIT's influence and research in the global economics community. Which brings us to today's keynote speaker, Professor Erik Berglöf. He is eminently suitable to speak in this conference, considering his long career and research interests. Before working at the Asian Infrastructure Investment Bank, he was the director of the Institute of Global Affairs at the London School of Economics and the chief economist of the European Bank for Reconstruction and Development. In both of these prestigious institutions, he worked intensively with emerging economies, especially in Eastern Europe. Before joining the EBRD, Erik was a professor at the Stockholm School of Economics, where he helped to build Stockholm's Institute of Transition Economics into a leading research institution. During his academic career, Erik has published extensively on finance, transition economics, and corporate governance in top economic journals such as American Economic Review and Quarterly Journal of Economics. Now I give the floor to Professor Erik Berglöf. His presentation will last roughly 30 minutes, so we'll have afterwards ample time for questions and discussion. So Erik, please, the floor is yours.
Thank you very much, and I'm absolutely delighted to be part of this celebration. BOFIT has been very important for me personally, but also for, much more importantly for the research on emerging economies. And also, I should say that I was listening earlier to the introduction or the speech, initial speech by Governor Rehn, and it reminded me of the history of BOFIT, which was, very, very interesting, and it had clear parallels to the venture that you just mentioned that we had in Stockholm, where we were trying to exactly preserve the knowledge of the economies in Eastern Europe and former Soviet Union, and what the very high quality research and analysis that have come out of BOFIT has been important for pursuing or building that area of research, and it's been also very important in building a knowledge base that wasn't there when this transformation in the Soviet Union and Eastern Europe started. If you go back in time and you look at what both the conceptual framework and the data wasn't there, and BOFIT played a very important role in establishing that, and of course then taking this also now to a much broader geographic space. So very much my hat is off to BOFIT for its contribution. And I also want to mention Pekka Sutla's personal support for me when I took over this role in Stockholm, and how he both gave advice and I think helped to convince people that I, at that young age, could build something meaningful in Stockholm, and I'm very grateful for that. And I also had that pleasure over the years interact with ICA on several occasions and with other people at BOFIT. So I'm very grateful for that. So and I'm also very grateful for that. I got to know of the Bank of Finland sauna, and of also the many opportunities I've had to discuss with Governor Rehn on many issues, global and European issues, and so again, my thanks to giving me this opportunity. So I want to share a presentation that hopefully you now can see. Is it visible?
Yes.
Yes, very good. So I'm going to focus on global value chains that they've already been referred to. Actually, the Governor Rehn referred to me in his initial talk, and I'm going to try to emphasize the role that they have played in both delivering peace and in prosperity. Or maybe say less about peace, but more about prosperity. But I'll come back to the peace dimension at the very end. Obviously, we don't need to be reminded of the importance of global value chains these days, because almost every day in the newspapers, headlines are about the disruptions and dislocations in the global value chains and the problems they are creating for consumers, for producers, for the global economy. And obviously the pandemic, impact of the pandemic is very clear, but we at AIB decided that we would like to look a little bit more closely at that impact, and also maybe look at the long-term challenges and opportunities that these global value chains have. So that's what I'm going to talk about. So just to remind us of the global value chains, what they are. I mean, there are somewhat different definitions out there, but the way we have thought about it is that when a product or service crosses border more than once, and you know, a good example maybe is the global value chains of a bicycle, where you know, if you look at it used to be necessary to produce a full bicycle or a full car, for that matter, to enter into these global trade. But with the development of these global value chains, it's become possible for individual countries to just produce a small part of it. And if you look at this bicycle, you see every component comes from a different part of the world, and that would have been very difficult for an individual country to produce high quality components that for all those parts that a bicycle, or let alone a car. And it's the disruptions to these individual components that are now creating problems in the global value chain. So, and it sticks out, if you look at the global context of these global value chains, is that have been incredibly important pathways for many emerging economies to join global production. And what I'm going to try to bring out is also how closely connected they are to infrastructure, and how the development of global value chains drives infrastructure development, and infrastructure development helps propel global value chains. So when you look at global value chains, there have been an overall slowing down in this very dramatic expansion that happened in the early 2000s and late 1990s. After the global financial crisis, we see kind of at the overall level of participations, the share of total exports that these global value chains account for has become more stable, around 50%. But actually that hides a very important shift, and I will come back to that later, in that in advanced economies, they may be slightly less important for total exports, but in emerging economies, including China, but not only China, they have become much more important and are very absolutely critical to their economic and industrial development. So there are a number of challenges, and the immediate challenge that drove us when we looked at these global value chains was the pandemic shock. And here we have both the lockdown, particularly since the lockdown started in the first major lockdown was in China, and of course China has been a very important and increasingly important part of these global value chains. So there was a lot of concerns about the consequences of that. But as we have seen, also the reopening of economies have created problems, both because of the very large built-up purchasing power in terms of savings and the stimulus programs, but also this lack of coordination or rather the lack of synchronization of opening up, the fact that different countries open up at different pace at different times and so on. That has created problems for these global value chains. And of course then we have trade tensions and policy, certainly before the pandemic, but also now as we're coming out of the pandemic, these tensions are very much there, and they will create an uncertainty for these global value chains. The last thing, or the other thing I want to emphasize is the technological change, and there's so much going on in these value chains, and particularly in terms of the digital infrastructure and the readiness to really exploit these opportunities differ across countries and maybe also within countries. There are large differences in different parts of countries that how much they can benefit from this. And finally, and this is going to be an important part of this presentation, is the role that these global value chains may have in the net zero transition. So you can think of it as both a challenge and an opportunity. These global value chains are coming under increasing pressures to decarbonize, and that is definitely, I would argue, the greatest challenge they face. But the upside of that is that they can also be part of driving the net zero transition, and they can create incentives for individual countries to further develop their infrastructure, and providing greener infrastructure. We can get something like a green comparative advantage process going, and that I will try to spell out a bit more later. So just to remind you, and I don't think you need to be reminded, that the pandemic shock persists. So these very dramatic shifts in prices of transport and so on are still there, and there are, as I said, a lot of dislocations. But on the whole, when we look at the initial lockdowns, it's remarkable how quickly these flows responded and came back, and particularly, let's say, exports from China rebounded very quickly and have reached record levels. And actually, as was mentioned, this year we have a record global trade. So despite these pressures from the pandemic, they have recovered very well. But there are, as we have seen, a lot of bottlenecks, and they are different in different parts of the global economy, and that creates problems. And I would say that it's too early and to assess the impact on global value chains. Certainly, there's a lot of thinking going on how to maybe make them more resilient, and how maybe to create alternatives, options for supply chains, or how to make them maybe build up slightly larger buffers. Having said that, the pressures on these arrangements in terms of efficiency are enormous, and they have driven this kind of ultra efficiency to extreme levels. So it's not going to be easy to fight that pressure. And another aspect is that these global value chains rely a lot on trust and personal relationships, and these relies on information being transferred, in very specific information being transferred, and to transfer that kind of information in a secure way and is something that puts pressures on developing personal relationships and so on. So there are forces going in both directions, and it's too early to say how they're going to play out. But I think we have to just watch out and see how this happens. And it's not going to be the same across all sectors of the economy and all industries. So, but in the long term, we would expect the economic drivers to dominate. And what we see right now is, of course, posed by sort of more short-term shocks. But as we talk about inflation now, that there's temporary, but there are many temporary, and they add up, and maybe eventually they become more like a permanent impact. So we have to be mindful of that as well when it comes to the impact of the pandemic on global value chain. So let me say something now about how one can think about approaching global value chains from a strategic sense, from a country, and how that relates to infrastructure development and what we have learned from sort of the last 20 years or so of experience. So the one thing I've already mentioned is the increasing role that global value chains are playing for emerging economies. So here is an attempt just to show how they have evolved since 1990 in terms of the share of exports that go through GVCs. And you can see that China and emerging economies have increased their share, while advanced economies are losing, relatively speaking. But here's showing across some important advanced and emerging economies how they are the difference in terms of their participation in global value chains. And you can see that there's still a lot of room for emerging economies to catch up with advanced economies. So we shouldn't expect this process to stop, or rather it might even be accelerated. And what is very important when we think about these global value chains and how they work and how countries strategically can relate to them is that it's not necessarily always good to move sort of upstream or downstream, for that matter. It depends very much on what are the specific context of individual countries, and you really need to look at each individual activity as part of this global value chain. Which activity can generate your most upgrading in terms of productivity, and you can see, comparing, for example, China and India, which are, of course, two very important countries for AIB, but also for the rest of the world. And you can see that China, and this is what people I think know a fair amount about, that China has managed to upgrade and move into more high productive activities, and maybe also outsource some low cost labor activities to other countries in Asia in particular. And they have taken more and more intermediate goods. So that has been the combination of sort of China's economic development over the last 10 or even 20 years has been to, on the one hand, upgrade in terms of productivity, but also capturing more and more of intermediate goods. And that, if you look at particularly the last 10 years, it's the most striking thing is how much China has managed to produce of intermediate goods, and that has been a very successful strategy for them. India, on the other hand, has realized its higher value added through what we call functional upgrading, looking at individual skills and trying to use particularly IT to enhance the value. So it's a very different strategy, but both have been successful in terms of increasing their participation in global value chains. And I said I was trying to focus on the infrastructure role, and here infrastructure is extremely important because it's really the infrastructure that allows this breakup of production processes and also exploit these cost efficiencies. They very much depend on the quality of the infrastructure. So if you have a better infrastructure, you can more easily exploit these opportunities. And probably when we look around and the left-hand chart here is meant to illustrate that this impact comes probably after sort of you reach a certain level. So you need a certain level of infrastructure, but once you have reached that level, you can, by improving infrastructure, you can also enhance your global value chain participation. It has to be cautious, of course, of what drives what, but there is clearly a strong correlation. The other thing is also that this connectivity and the ability to use infrastructure, the quality of the infrastructure, becomes more important for more complex products and products that maybe often need to move many times across borders before they reach their sort of final product. So these two things are important elements when you think about infrastructure and DVC participation. So you can think of both activities that are sort of pre-production, design, research and development, and building brands. This here infrastructure plays a role in sort of facilitating face-to-face knowledge exchange, and often we see a lot of this happening in urban areas where the people congregate and so on. But also in post-production activities, you have after-sales service, marketing, ICTs for engaging with customers and improving logistics. So all that are activities that can help. You can become better at this and attract global value. And here there's a sort of observation that if you look across countries, the ability to benefit from this and achieve that upgrading is going to depend on how developed your digital infrastructure is. So clearly, if you don't have a very developed infrastructure, or if the differences within countries, like for example in India, very large differences between different parts, different states in India in terms of the quality of the infrastructure and how connected they are to the internet, that's going to create trouble. So this digital divide can become a very important constraint when you want to exploit these benefits of the global value chains and when you want to attract global value chains. So to summarize, when you think about infrastructure strategy, so think of yourself as a company or a lead firm in one of these global value chains, you need to think about the quality of infrastructure to, as I said, exploit those production processes and those efficiencies. They really depend on the quality of infrastructure. And of course, the different parts of the value chain and different sectors require different infrastructure. So you need to think about what value chains do I want to be part of, and where in those value chains do I want to emphasize my participation, and that will then impact what kind of infrastructure I want to build. And of course, digital infrastructure here is, as I said, absolutely critical, and they are, as we speak, transforming value chains, and these value chains are becoming much less and less about production of individual goods, more and more about services, but particularly more and more about information flows, very granular information, helping to make these value chains more effective and more efficient. Let me give you two examples now from the region where I have the pleasure and responsibility to work. And so you start with China, and we already said something in China. It's clearly the case that China has moved to higher value global value chains, and you can see here how connected China is and how important it has become. It's really only the United States that has a similar importance in terms of global value chains. And you can see also here how much the high technology has increased over the last 20 years or so. So clearly, China has been very successful in exploiting these global value chains and increasingly own and control a larger part of these global value chains. And also, global value chains have been very important for developing China's interior. For those who follow China's sort of modern economic history, or it actually goes back even predates that, the challenge of developing the interior of China. But actually parts of China now that seemed very remote in the past, places like Sichuan, or Chengdu, Chongqing, these have become really high-tech centers and made China's development more balanced, particularly between the coast and the interior. Of course, you still have also a shift from the north to the south, and with all this, the connection to these global value chains have become very important. And I should say also that part of the development of the interior has benefited from the improved railway connections to Europe, and that has been a very important driver, particularly in Chengdu and Chongqing's case. And China is very much planning for a digital future. And if you look at the adoption of robots, but also how they expand 5G towers, it is extraordinary how fast this has gone and the pace at which it continues. So China is dealing with the digital challenge in a very effective way. So a few words on India as well. So as I said, India has managed to increase its global value chain participation, but it still remains a relatively small player, certainly compared to the size of the population. But what has its characteristics of China's participation, and particularly its GVC participation, is that it is focused on a few states, so Maharashtra, Gujarat, and a few more states, and that has there's also a correlation between the quality of infrastructure and also institutional quality is very important, and that is something that when India wants to increase its GVC participation, you need to think about how can we get more parts of the economy involved in these global value chains. And yes, as I said, about the better regional infrastructure helps global value chain participation. We did quite a bit of work on trying to understand the challenges in terms of connectivity, and we focused on the role of ports because we had some interesting data that we could look at, and you can see here that it differs a lot across different ports in different parts of the country, how good access they have to these ports, and that's going to be critical for India to both of course, get access to ports, but also use airports and develop their highways to improve connectivity and connect parts of the economy that are not so well connected yet. So this was, on the one hand, looking at from the perspective of a company that wants to control these value chains or help develop these value chains, and then how the impact it's had in two countries, India and China. Let me say a few words about how I could think of this from a sort of policy perspective. If you're sitting in one of these countries in the emerging world, the developing world, and you want to join and attract global value chains, then we have a very embryonic framework to think about this. There's more to be said about this, of course, but just a couple of dimensions to think about. one is, whether you're actually focusing on GVC specifically, or if you implement policies that are sort of neutral. They help GVCs, but they help also the rest of the economy. And then you can think of policies that are sort of place-based, focusing on a particular place in the country, or place neutral. So not really focusing on a specific area. You could, so you have something that is sort of GVC sensitive, and place-based would be special economic zones. And as you know, many countries in Asia has, with varying success, used special economic zones. And of course, special economic zones, a very important part of that is to have very strong infrastructure and offer multimodal infrastructure, offering high-speed broadband and so on. And then you could look at something that is sort of more neutral when it comes to global value chains, and also more neutral to place. And there you have the more traditional things around institutional quality, business environment, and soft infrastructure. A lot of, I think, digital infrastructure would also be placed in this box. And so this is just to give you a sense of the kind of dimensions, some dimensions that you need to think about when you're trying to attract global value chains and expand your participation in global value chain. So that's the rich policy options. One's about focusing on institutional support and soft infrastructure. Trade policy is obviously going to be important as improving regional connectivity, and also what we call place-based intervention, special economic zones. And there are also specific institutions, and again, in Finland, you know a lot about this. How to use investment promotion agencies and institutions specifically supporting maybe global value chains or multinational companies' activities, and also thinking about how you can attract more local content in your country. So this is sort of the options. So let me come to the area that I think for us stood out as the most interesting and most promising area for thinking about the future of global value chains. And on the one hand, as I said, this is a challenge for these global value chains. They're transporting products across borders, very long distances. Obviously, that has a carbon footprint, but most of the carbon footprint actually comes from the production itself. So how can you deal with these pressures now on lead firms, but also on individual countries to meet their so-called national determined contributions? And we see the discussions now in Glasgow around how to achieve that and get as many countries to commit. But of course, in the end, you also need to implement this, and that's the real challenge. And that's where I will argue that the global value chains have a very important role to play. And if you really want to sustain these global value chains in this new net zero transition context, you need to think about how to establish renewable energy production, how to get renewable energy trade to facilitate across borders and within countries. In China, for example, there's some real issues in terms of the having two grids and having imbalances within individual grids in individual provinces, and how do you deal with that? And then there's what we call the green comparative advantage, the idea that you can actually compete for GVC investments by offering green power. I mean, we have seen this also in the Nordic countries now, that the access to hydro power, for example, attracts a lot of energy intensive industries. We have the same in China. Yunnan province has attracted a lot of aluminum producers, for example, and that creates its own challenges. But you can very much use both when it comes to energy production, but also when it comes to transport and logistics, and maybe this could be additional incentives for countries to contribute. And of course, ultimately, you need also international governance to get markets in offsets and so on to work and establish what is really contributing to the net zero transition and what is not. Of course, here the lead firms in this global value chain become very important. We actually in the report we are using a Finnish example, actually, Kesko, to illustrate what lead firms can achieve, and so one, just a few examples. I mean, by imposing a carbon price, we know how difficult it's been to establish carbon prices in different parts of the world, and it's only now recently that the European mechanism seems to beginning to have some bite, but it's in practice it's still probably marginal compared to other impacts. So lead firms can sort of start pricing in emissions impact in their production and inputs and so on, and look at the whole value chain, and that is starting. There are many companies that are very deep into this now, and as I said, we give Kesko as an example in the only real example actually in this report that I'm presenting here. So they also, of course, having common standards. This is to make sure that everything across the value chain happens with the same standards, and that's again the real strength and the sort of economic rationale and driving force behind these global value chains is this ability of the lead firm to govern the whole chain, and the more effective it is in governing, the more effective the global value chain is, and the more efficient it is. So that's, we can think of that as a capacity also to implement these decarbonization, and of course also creating transparency around data, so we actually know and can hold these lead firms accountable, and they in turn can also impose this on different suppliers in the value chains, and this can really become a very important role in driving the transparency and this notion of traceability, that we can trace where these individual components come from, what their carbon footprint is going to be extremely important, and this again, the lead firms are going to be the drivers of that. The other side of this is looking at it from the sort of host countries, the countries that AIB is working with now in Asia. They have to look at how can we get more out of these global value chains. Well, we can offer these decarbonization opportunities. I mean, as I mentioned, renewable energy, environmentally friendly and circular economy production, efficient, effective multimodal green transport systems, access to inputs that preserve biodiversity. So all those things are going to be what we call green comparative advantage going forward, and it can become very important drivers, we think, of the development in this part of the world. To summarize my conclusions, so we think that the global value chains can offer climate smart development opportunities. They can offer transformation opportunities for emerging and developing countries. They give us an additional tool to achieve the net zero transition. And we are struggling to find ways of enforcing these commitments across countries. And here we get an additional mechanism through these lead firms and the incentives we can provide to countries to try to attract these investments. And finally, coming back to the sort of headline of this brief keynote, is we are hopefully building large stakes in peaceful coexistence and common prosperity in Asia and beyond, and by establishing these connections across countries. We're seeing now, of course, attempts to break up these connections, but in the end, we are so closely interlinked, and we need to rely on our ability to sustain these links and maintain these important productive opportunities across countries. So with those words, kiitos, and thank you very much for inviting me.
So, thank you, Professor Bergilöf. Thank you, Erik. It was highly interesting. It's good to notice that even with the pandemic, global trade has not suffered hugely, or the hit was short-lived at least. Global value chains, they are needed also in the future to maintain global standard of living, and they can facilitate the green transition, if I understood correctly. So now it's time for questions and answers from you, from the audience here, and from the online viewers. But to warm up, let me make myself the first question. In one of your slides, it indicated to me that the participation in the global value chains is still quite low in many emerging economies. Now, what can be done to increase it, besides building more transport infrastructure? Are there trade restrictions curbing the participation? And if so, are they mostly on the high-income countries' side?
Yeah, no, so this is an important question, and we tried to look a little bit at this because, as you know, in Asia, we have just had this very important new trade arrangement that hasn't actually come into force yet fully, but RCEP, RCEP, that is, so some of these trade arrangements are not so helpful for global value chains per se. So RCEP, I would argue, is focusing not on the main issues that these global value chains are confronted with. It's more on sort of manufacturing and not dealing so much with the real issues here are about standardization, getting information to flow more smoothly across countries. And I think here the type of trade arrangements and trade policies that are associated with the other big mega agreement in Asia that's taking form, the following up from the TCP, that, and whether China now has applied to join, along with the UK, by the way, and I think that deals exactly with these standardization issues and the kind of things that will really help also emerging and developing countries. So I'm not responding directly to your question whether the fault is with the advanced economies or the emerging and developing economies. I think both sides are struggling to and could contribute to developing these links, but doing so within one of these larger sort of mega arrangements. I think that's the most effective way to promote this these arrangements.
Thank you. And now we have the first question from the floor. Naura, please. I think it's one of the microphones.
All right, Eric. Thank you very much for the presentation. It's a real pleasure to see you, and for the people who haven't heard you before, I'm sure they like it a lot. But I was expecting it to be excellent and thought-provoking, and that's exactly what I got. I have a question that is, in a way, a continuation that Thomas raised it, and because this is a 30th year anniversary conference, I'll start with a short memory, by the way, because when after my PhD, I came back to Europe, and my first conference was in Gothenburg, May 1998, where I met Jukka from BOFIT, and then I took a train and I spent 2 weeks at site, and Eric very, very generously hosted me there, and I have wonderful memories of that too. Then, my question is the following. Thomas asked you about, you raised a number of great issues, but the one that really caught my attention was, you mentioned it 3 times during the excellent presentation. The first one, you spoke about trust, and then you talked about institutional quality and then institutional support, right? Then my question is basically, at the policy level is Thomas' question, right? What can we do in terms of institutions to improve access to JVC participation? And then this is the policy question. On the academic question, as soon as you mention it, I Google Scholar, trust in GVCs and institutions, and there's nothing. The most sites, there are a few papers, 24 sites, very, very little. Then if you can, once again educate me, and if you are doing some work on this, or who you think is an important person to talk to about institutions and GVC. And I'm asking in the context of, changes in integration, of course. There's this thinking going on that, trade-centered integration is kind of finishing, and these days mostly institution-centered integration, and that's the motivation for the question. Then maybe you're doing some work over there. I couldn't find it, and I would really appreciate any light you can shed on this issue. Thank you very much.
So, thank you, Naru, and thank you for those kind words. And I knew that it would come. If you would ask a question, it would be a difficult one to answer quickly. But I think the bottom line is that we haven't done any major work on trust as such. There, the kind of work that I think is relevant is the work that people like Luigi Sengales and Paola Sapienza and Luigi Guiso have been doing, a lot based on Italy, actually, and very much inspired by Putnam's work in another discipline, and trying to measure the role of institutions in promoting trust and so on. So there is some work, but there's certainly room for a lot of more work on that. Going back to the previous question, to building trust, having these frameworks that provide common standards and encourage transparency, I think that is the way to build trust, and something that we can certainly do more of, and if we want to develop these relationships. So let me leave it with that. But you're touching on a very important issue, and a very important issue, as I said, to assess also what's going to happen to this global value chain from this shock that we're going through right now. So my bias is to think that well, certainly things will not look exactly the same but my bias is that we are going to move back to something that is very relationship based, and in that sense, maybe we're going to rebuild a lot of the kind of trust relationships that may have been broken or at least affected by these shocks that the pandemic has brought. So I think trust is absolutely essential, and in your own work, by the way, has also been both explicitly but often implicitly dealing with that, and I think it's worth to revisit that work and think of global value chains in that context. Thank you for the question.
Thanks. And the next question.
Yeah, thank you very much. Gabriel Fabermeyer from the Austrian Institute for Economic Research. I was wondering what you think, Eric, about the European idea of having a carbon border adjustment mechanism as a response of non-uniform global CO2 pricing. Of course, we're all interested not only in your views, but also in how the IIB and China see these European ideas. Thank you.
Yes, I think this is obviously a very sensitive issue, because you can see to the two sides of the argument. One is that, of course, if we in Europe, or I should say maybe you in Europe now, but we in Europe impose these or impose rules for domestic producers and domestic consumers. Just allowing, like we have done, by the way, over the last 30 or 20 years at least, moved out a lot of the high carbon intensive production to places like China, and then now we come back and now we are trying to reduce our own. Of course, we cannot solve our own problems by moving out this kind of production in the long term. So we need to think about how we prevent also others from sort of undercutting us, because they can pollute or they can produce CO2 without the same costs that we are imposing on ourselves. So I understand that argument, and I think we need to have those kind of mechanisms. On the other hand, looking at it from the perspective of emerging economies, it can be used as a tool to punish them, and maybe you would have to, I think, appreciate that if you're coming from a much lower level of industrial development and prosperity, it takes a longer time to achieve this transition. So there will be a time when we need to, I think, understand that these can hit very unfairly countries that are in a different state of development. So I think these kind of mechanisms will have to be put in place, but I think they should be put in place with a lot of caution and think about also the long-term importance of keeping everyone engaged, or as many countries and governments engaged in this net zero transition, and not introduce new tools and use these tools to maybe create new obstacles to global integration.
Thanks, Eric. We are running out of time, but I have still two questions from the floor, though. So let's take them both one after another, and then let you, Eric, have the final word. So please.
It would be very interesting to learn how you assess the possibilities of the development of a northern route from the Pacific into Atlantic. There's much talk about it, but I haven't seen very much in the real world. Thank you.
Thanks, and the other question from the other side.
Thank you, Mikko Puustinen from the Ministry of Economic Affairs and the Employment. Thank you for the very interesting presentation. You mentioned how China, and particularly, but also India, has been able to increase its share in the global value chains. Against that background from Asia now, so how do you think Europe is doing in terms of keeping, if not increasing, its share in the global value chains? Thanks.
Thanks. And now to you, Erik.
Yeah. So on the first issue of the northern route, I don't know enough. I haven't looked at it in a meaningful way, so I can only provide sort of superficial answers to it. But the obvious observation that I already made is that the importance of the improved rail linkages between China and ultimately Asia. Actually, a lot, maybe many of you don't know this, but actually a lot of Japanese and Korean exports now go through China on these rail links, because so they actually ship to ports in China and then transported all the way by railways because of the challenges that they have now with the costs in shipping and the access to containers and so on. So the importance of these links for which parts of China, for example, or parts of Asia that will benefit from the global value chains are extremely important. So if a route could be created, and a lot of, I guess, a lot of evidence suggests that because of climate change and so on, that it will be easier to have that, and you will save considerable time by transporting that way. That will have an impact also on global value chain. But as I said, I haven't looked at it, and I don't know when in time these different impacts will really start having a bite. What is interesting is that countries and like China and India have actually paid increasing attention to what happens in that part of the world, and as you know, they have tried to join, or they have joined the international governance arrangements that are for that part of the world. So certainly they are aware and are thinking about what the impact may be from something like that. On Europe, so of course the global value chains, we don't maybe think of them as global, but the value chains that developed between Western Europe and Eastern Europe have been extremely important for Europe, and they have also been extremely important for Eastern Europe and Central Europe in particular. If you look at how they have managed with their own upgrading and their own prosperity, and how they have managed to occupy more space in that. But if you look at the data, unfortunately, Europe is losing ground in these global value chains, or at least, again, one has to be careful here. That some of this production, maybe it is better for Europe that it happens in a more efficient place. But if we really look at the objective of participating in global value chains, Europe needs to think about how it can create better conditions. I think what's hopeful here is that if you look at this last part of the presentation that deals with the climate dimension and the greening of the economy and the decarbonization, there Europe is very advanced. And if you look at the share of dependence of fossil fuels, many European countries are clear leaders and have improved a lot over the last 10 or 20 years. So this could create new opportunities for Europe to take more space in global value chains by offering, like what's happening in the north of Sweden now, and I presume something I haven't actually followed the impact it may have had on the north of Finland, but certainly in the north of Sweden is benefiting tremendously now from this desire to have access to green power, and I can see that opening up opportunities in other parts of Europe where you have made conscious investments in these elements that I have emphasized that will be attractive for these lead firms that are controlling these global value chains.
So, thank you, Eric. Somehow it seems to me that during the pandemic, the views on global value chains have changed a lot, back and forth, but what doesn't, even with I'm monetary policy maker, and 12 months ago everybody was talking about Japanization of Eurosystem, now everybody's talking about inflation, so everything changes so rapidly. But I think we need to thank you, Eric, so that we'll stay on time, so let's give a big hand to Eric.
Thank you.
And Ika, you probably want to say something on the logistics. Thank you.
Okay, thank you very much. Thank you very much, Eric and Tuomas. Now here in Helsinki, in the Grand Central Hotel, we break for lunch. Those of you following online might do lunch or whatever. My understanding is that we go directly through those doors on my right side, and Riikka Virtanen over there, who's done all the heavy lifting for the conference, will actually lead us to buffet lunch in the restaurant. And we reconvene in 1 hour here, where we have the session on intersection of politics and economic outcomes. Okay, thank you very much. Okay, I think it's time to restart. And it's time for the last session of the Anniversary Conference. So, intersection of politics and economic outcomes. The session will have two presentations and prepared discussant. And we'll go into order that people are in the program. So first up, we will have head of Austrian Institute of Economic Research, WIFO, Gabriel Felbermayr, and he will talk about sanctions. So he has written extensively on international trade, international economics, and more recently also on sanctions. Up until quite recently, actually, to the end of September, he was the president of Kiel Institute for the World Economy, where he was employed when we first approached him about the possibility to come here. But I'm glad that the invitation carried over to WIFO as well. So without further ado, please, Gabriel, the floor is yours.
Yeah, thank you, Ika. It's very nice to be in Helsinki. And indeed, when I was in Kiel a couple of months ago, I was looking forward to coming here in particular because the Baltic Sea unites the city of Kiel and the city of Helsinki. And now, as an Austrian back home to Austria, I'm very happy to be here as well because small Eurozone economies like the Finnish one and the Austrian one need to cooperate and to gang up sometimes, to be heard in Europe. Here is a paper that's one out of a larger series of papers that I had the privilege to co-author with various authors, in particular Yoto Yotov, who is also a co-author on this paper, and Kostas Siropoulos, both at the Jackson University in Philadelphia, and Erdal Yalcin, who was a colleague of mine when I was still in Munich. And then there are doctoral students on this project. And there are many authors here because we have many papers and we share authorship of those many papers. But what's backstage really is a new database on sanctions that database lives and needs a lot of maintenance work. And that's where the doctoral students come in as because it's at the end coding of legal documents. Still we have, maybe one day we'll be able to automate that and move it into, and have robots code those texts, but we are not yet there. Now, what's geoeconomics? I think that's more or less the overarching topic of this session. And my definition of it is really the pursuit of foreign policy objectives with economic policy instruments. And sanctions, of course, economic sanctions are such instruments. And we can have positive sanctions, of course. We would call them maybe persuasive instruments, like trade agreements or other concessions, tariff cuts, or it could be investment agreements, carrots, if you wish, to influence policy making in foreign countries. But then, of course, we also have coercive instruments and also called negative sanctions. And here we talk about the withdrawal of earlier concessions or the withdrawal of market access. We no longer allow foreign companies trade with companies from our jurisdiction. And what we have seen is an increased interest in these in geoeconomics more generally. I'm just putting two books on that have impressed me quite a lot. The first that I want to mention is the one by Bob Backwell and Jennifer Harris, Geoeconomics and Statecraft, War by Other Means. And these books, both of them, are written by political scientists. So as economists, we come in a little bit later. But that book, War by Other Means, really for me, it appeared in 2016, was a mind opener. Very, very interesting. It described how you use economics from tariffs to monetary policy, to regulation and standards to influence other countries, to impose your will also sometimes on other countries, to coerce them into something. And these political scientists really give a long, account of how the US has gone about it in the past and recommend that the United States use this toolkit much more intensively. And just a year later, when this book came out, presidential elections brought someone into the White House who was a big champion of using tariffs to achieve foreign policy objectives. And you all know whom I'm talking about. And then 2020, Daniel Drezner, Henry Farrell, Abraham Newman, again, political scientists, put up this collection of essays, the uses and abuses of weaponized interdependence. And weaponized interdependence really is a buzzword that Abe Newman and Henry Farrell developed. Many people have spoken about it. Again, not so much in economics, more in political science. And the idea of is to exploit economic interdependence, mutual dependence, we would say, importing and exporting, financial interdependence, dependence on exchange on labor markets, to use that to coerce or persuade foreign governments to change their course of action. No? And I think there is a small literature in economics that deals with these issues. A prominent paper that I like a lot is the one by Philippe Martin and co-authors that came out in the AR like already 15 years ago or so, with the very interesting title "Make Trade, Not War." We just had a talk before the lunch break about GVCs, and there was the word peace there somewhere. Eric didn't talk too much about peace then, but peace and prosperity and how integration could actually lead to these outcomes. The Martin and other papers tried to put some empirics up to test this hypothesis, and they find, trade can lead to more peaceful cooperation, but it can also do the opposite. In particular, when economies are already very diversified, they can afford to break an economic tie with a specific trade partners more easily. Also, there's a difference between multilateral openness and bilateral openness. And I think what we have seen since the arrival of Donald Trump, very much so, but even before, the whole economic system was shaken up in the last big recession, 2008-9, is that dominance politics increasingly replaced positive sum politics. And trade economists, and in particular, I think all of us who more or less believe in the value of division of labor, of cooperation, we all bear with us this positive sum politics, or this positive sum logic, that by cooperating we can increase the size of the cake and everyone will be better off in absolute terms. Dominance politics is a little bit different. It does not look at the overall size of the cake, but at the distribution of the cake. And what is the objective there is to be the first. It's not so much about, solving the prisoner's dilemma and get cooperation as an equilibrium outcome. That's what we do in positive sum games. It's more a competition for being the first. And being the second or the third is not good enough. You need to be the first. And that is what describes, I think, the political science logic much more than the economic logic, and also makes us maybe understand changes in how the Americans think about or have thought about the global market, where it's not enough to benefit from globalization. You need to be benefiting by more in terms of percentage changes than your geostrategic rival, because that's what matters in your objective function. Now, for economists, sometimes not so easy to understand, because we are happy if absolute welfare increases, while the political science literature is more obsessed with relative welfare. Am I benefiting more than my competitors? And this dominance politics emerges whenever trust is insufficient. We talked about trust already, and I think very rightly so. If you don't trust in the rule of international law, and you fear that your trade partner might not, send the products you need, or might tax your exports in a opportunistic way, if you don't have the trust that this type of behavior is ruled out, then you worry about who has leverage, who has more power in a potential conflict. And then we are in this dominance politics situation. And that corrosion of trust and the emergence of dominance politics, I think, is at the core of the crisis of the WTO and other multilateral institutions. If you have read maybe the literature on why GATT, the General Agreement on Tariffs and Trade, and the World Trade Organization actually worked over the history, by Bergwall and Steger, for example, then you know that their argument relies very much on positive sum logics, that what policymakers care about is the absolute level of welfare. If you take a different objective function, a different pair of functions, and say, no, that's not what they care about, they care about being the first, then this entire beautiful theory, all these proofs and lemmatas, there's all the mathematics that's behind the game theoretical foundation of multilateral cooperation breaks down. That's something that I like my graduate students to go through, because it's easy to show, and very quickly the whole logic disappears. Now, we are trying to contribute to the literature of sanctions, and that's a big literature. As I said, it's dominated by political scientists. There are exceptions. Gary Hufbauer from the Peterson Institute has become famous. He's been the first also to come up with data on sanctions. But what I want to do is not here give you a long literature review. That's the part of it is in the paper. What I want to talk about is threats and sanctions that are actually imposed, because that is an important thing to conceptualize. Threats, as we know from game theory, are not very often observed. You make them, and you make them maybe even in a very implicit way. You don't even have to say something. It can be implicit. And when you can signal that you would sanction someone if someone deviates from some cooperative or some other way of action, then that other player would behave in such that the threat doesn't materialize and the sanction is not imposed. So very often we don't see sanctions. We see maybe the threats, or even more often, I think we don't even see the threat. Now, Cliff Morgan and co-authors have tried to measure that, to come up with data, collect statements of politicians where they actually threat someone and say, if you don't do this or that, we will sanction you. In the European Union, we do that all the time. We say, if the Polish don't do this and that, then there will be withdrawal of funds and so on. So it's very much there. But coding that, putting it into data, and then using that in econometrics is a formidable challenge. Now, what we have in our database is observed sanctions. Much easier to code, because there is a law there, or there is a text, a legal text there. It's not just a threat. But what we observe in the data then is essentially unsuccessful threats, because the threat that does not work, because the threat alone does not change the other government's behavior, that leads, either to a government to give up. So, okay, I would have liked to change your behavior. You don't do it, so, okay, I move away. Or the government would have to say, in order to remain credible and to keep my threats as a credible policy instrument alive, I need to go to action. I need to then impose a sanction. And so that is what we observe. And that's what we can use then in empirical work and quantitative work. The threats we don't really see, but it might be those implicit and explicit threats that are much more important if you want to understand how geoeconomics shapes economic outcomes. But it's, as I said, very difficult to observe. Successful sanctions that are threatened and that where the targeted country complies might not even have any effect on the outcomes. But when it comes to escalation, when the threats don't work and you need to impose the sanctions, then we should see strong effects on the sanctions, let's say, relationship, because that's in the essence of going from the threat to the imposition of the sanction. Otherwise, that's how credibility is built. So what we do in our own previous work, and much of the work where economists have concentrated, is to show that such effects exist, so that the threats, that sanctions actually do destroy economic activity. And we try to do that. We try to do this measurement exercise as good as we can, with new data and so on, avoiding limitations of research of the past. And what we don't do here in this paper and in other papers I have co-authored with these colleagues is to really look at how those sanctions are changing policy outcomes. And I think if you're interested in that, you need to get a handle on threats, because the threats ex ante might do the work, and the escalation, the sanction itself might not too much. But what we're interested in is the time patterns. No, because by looking at the period that predates the imposition of the sanction, we might get a glance into what threats do, right? Because before the sanctions actually imposed, you probably talk about it, or you make it feel. You don't talk about it; you make it feel to another government that you might react by imposing a sanction if they don't change their policy choices. So before I go through some results, I'd like to do some advertising. So this long list of co-authors and we have put together the Global Sanctions Database. It's a public good. So if you're interested in using it, please tell us. It's available for free. It's a living database. So we still have coding errors in there and so on and so forth. And we try to update it regularly. So the last update now includes the Trump years. And you can read it. You can read the details of it. We are, I guess, the largest. We have the largest data set on sanctions in terms of country coverage, time span, sanction types. We make a lot of distinctions. It's not just counting episodes, but we do code them into complete and partial sanctions. So partial sanctions are such that they only cover certain products. They say complete sanctions cover the entire relationship. They can be applied to imports, to exports, or they can be reciprocal. Then we have them on both sides of the trading relationship. We can have classical trade sanctions. That's what I will be concentrating on in the next minutes. But there are also other types of sanctions. Some, sanctions used in the past concentrate on military equipment. When you want to, if you want to de-escalate a military conflict somewhere. But increasingly, we see smart sanctions. And smart sanctions are those related to movement of people, so it's a travel bans or travel restrictions, or financial sanctions, freezes of foreign assets. All that's in the database, but I won't use it. And then we can also ask who is actually doing the sanction. Is this a coalition? And how big is the coalition? If the coalition is the UN, then we talk about multilateral sanctions. If the coalition is just a subset of the UN, that's the plurilateral sanction regime, but it could also be only one country who does the sanctioning, and then it's a unilateral sanction. We all make these distinctions, and so you're invited to use it, but what we're talking about here is a database that has still a very much a macro flavor. What you cannot do is go through, the 8-digit products, have thousands of products on which we have tariffs, all the tariff lines, and ask, is this product included in the sanction regime or not? That's something that this database cannot do. But it has, I think, from the 1950s onward, all sanctions imposed anywhere in the world. And for that, I think it's a valuable resource. Now, we're talking about this because it has become more and more frequent. Here in these two charts, you see that you see the potential share of trade in panel B that is affected by sanctions. Potential because not all sanctions are complete, but so this could be it could be an overestimate. But the trend is very clear. The share of trade affected by sanctions has trended upwards, very much so. There's ups and downs. So in the 80s, there's a lot of sanctioning of communist regimes, but if I were to prolong that into the Trump period, Trump has been a very eager user of trade sanctions as well. And in terms of the dollar value, that's the panel A, you see this increase as well. But I think the more interesting chart is actually the chart B. The EU and the US are very frequent users of sanctions. And the trade that's covered by US sanctions is about 2.5% in 2015. It has grown since then. And the EU even a little bit more. So we use sanctions also in Europe quite heavily. And what we do observe too is a move towards more targeted regimes. And there are many ways to illustrate that. So we have, governments are using more targeted instruments, persons that you can, target if you want. But one way to put it is to see that partial sanctions are becoming more prevalent. Also, this is the light blue shades here in panel A. They've become larger. Complete sanctions are those that cover the entire imports or exports of a country. Then later, I will be focusing on complete trade sanctions. We will looking at the macro picture, and their complete sanctions, of course, have the largest bite. But I'll show some results on partial sanctions as well.
In this specific paper, we're concerned with the duration of sanction regimes, and we have a couple of new stylized facts I'd like to flash here simply. First of all, sanctions, from the 1950s to today, this is thousands of sanction regimes. They have a duration of 6 years on average, but the median duration is 4 years. So the fact that median and mean deviate quite strongly means that we have very skewed duration, a very skewed distribution of the duration of sanction regimes. So that's one important thing. And this next bullet point just illustrates this skewness, saying that 14% of all trade sanctions last more than 50 years. 5 years, so 86% of them last less than 5 years. So many sanction regimes are short-lived, fortunately. But there are these very long-lived ones that we mostly talk about when in the sanctions literature. And we think the duration of sanctions, also the expected duration of sanctions, matters, of course, in two ways. One trivial way, of course, if the episode is long, it will destroy more welfare. But also, when people anticipate the sanction regime to last longer, then there will be a deeper fall. You will cut, trade will fall by more if you think that in the next years and the years to come, sanctions will remain in place. And just aggregating over targets, Israel, for example, here, the top bar in chart A has been under a sanction regime for almost 60 years, almost since its existence. Cuba, the People's Republic of Korea, but also China, South Africa, have suffered for long periods under sanctions regimes. While on the right-hand side, you see that countries like Croatia or Bosnia, Serbia, those involved in the Yugoslav war, have been under sanction regimes, but much smaller periods of time. African countries move in and move out of sanction regimes. Often you get sanctioned, then the sanctions are lifted, and you get sanctioned again. So all these episodes then give rise to short-lived episodes of sanctions. Now, in this paper, what we do is run gravity models. This is what my co-author Joto Jotov does for his living. He is one of the those people in our profession who really have pushed the frontier in making gravity models fit the theory better and also econometrically advance them. And the equation that we're estimating is this one here. It looks a little bit complicated. In the paper, we say at many places that this is how you should do it now. After 25 years or so of methodological advances in this literature, you should have you should use a PPML model. That's what the last bullet point says, a Poisson pseudo-maximum likelihood model. I'm not going into the details why that's the appropriate way to do so. Just let me say that we have a lot of zeros in trade data. Not every country pair trades with each other. And dealing with zeros in econometrics is often tricky because we like to take logs. But if you take a log of a zero, you're in trouble. And so a model in levels like this one, where the trade flow on the left-hand side is as we observe it, not logged, not in logarithmics, has some advantages. In efficiency, on efficiency grounds, but also on other grounds. More interesting maybe is that we use a lot of fixed effects. We don't observe important determinants of trade. How to observe the stance of fiscal policy, of monetary policy. How to observe the deep bilateral relationships between two countries. The trust between traders in two countries. The history, we know it matters. And if we use fixed effects, that's what this model does, then we can control out for these characteristics in a neat way. More interesting than that, we have all these terms that are connected here with CTS. CTS are complete trade sanctions. And what this equation tries to do is it tries to estimate with alpha the contemporaneous effect of the sanction. So if it hits on period T, that's the alpha will measure its effect on trade. But then we also have lags and leads, and these are the alpha S and beta K coefficients. We want to know whether trade is affected before the sanction regime starts, and we also want to know how trade recovers maybe once the sanctions are taken out. And then there is all sorts of other controls in there. And as usual, I should mention the word endogeneity. Maybe now we'll dwell on that. But of course, that's the big issue. If these alphas and betas actually causally identify what we want to measure, we think they do to a reasonable extent because of all those fixed effects that take out trouble. Now here is what happens. Yes, here's what happens. You see that in the middle of the graph, at time t, that's where the sanction actually hits. So that's a year where sanction is in place, and the coefficient that we estimate is at somewhere minus 1.7 or so. No, and you also see that when the sanction is relieved, that's the year t plus 1, and then the years thereafter. So everything that's t plus something is with the sanction regime already no longer in place. You see the trade remains lower than before. No, but you also see it recovers. More interesting than that is maybe that before the sanction is even put in place, you already have a period of lower trade. The statistical significance is not always there, so we cannot always say that there is a strong econometric evidence, but overall the picture does suggest that before a sanction hit, you have this period of unsuccessful threats that already lower trade volumes. Now, translating this coefficient of minus 1.7 or so means that contemporaneously these complete trade sanctions are quite strong. They reduce bilateral trade by 82% on average. Now we have hundreds of sanctioned regimes. There's a lot of heterogeneity within the sanctions. We have a paper that tries to check what are the sanctions that really produce this big effect, but that's an average. Some of them are less dramatic, others are even more dramatic than this 82%. What we also see is if we ignore the pre-treatment and post-treatment periods and estimate only the contemporaneous effect, we become too optimistic. Sanctions are not as, they don't look as detrimental as they actually are. Why is that? That's because by including all these other data points or these other treatments, we change effectively the control group for our econometric exercise here. So it's important. I mentioned that sanctions before the imposed seem to lower trade below the norm already. And one thing that I find quite interesting is this, that before the sanction is introduced, the year before it, trade is already lower. And then as trade recovers, it actually outgrows, again, not totally statistically significant there, but it tends to outgrow the pre-crisis level. In other words, there could be some resolution mechanism. No? Once the sanctions has been lifted, the problem is probably hopefully out of the way. And then trade can recover to more than it was before, because before the imposition of the sanction, you had there was hopefully a problem, and sanctions are not imposed for, just for the fun of it. So that's the main picture. Now, what we can also do is look into that treatment period, because sanctions take time, the duration of the sanction. What we see is that, we have a lot of robustness checks, but regardless of how we do it, the longer a sanction is in place, the stronger its negative effects are. We're always talking about the bilateral trade effects. No? You see that in particular in panel E here, the right one, on here, you see that the coefficient that we estimate go down to something like minus 2.5 or so as the sanctions take longer. And then the recovery afterwards. We have a difference between long sanctions and short sanctions. Long sanctions, we really see a strong break in the trade flows and then the recovery. Short sanctions, not so much. And it's probably the long sanctions that are used when there is really no other way of dealing with a problem with a trade partner. No? And so knowing that there is no way out, people expect that those sanctions remain in place for long, and rather than getting this gradual decline over the sanctions time, you get an immediate reduction in trade, while the short sanctions are not of that nature. We can show that there's a difference between different sanctioneering countries, or or different coalitions. We can show that bilateral sanctions are more effective, but for destroying bilateral trade. Multilateral sanctions are those by the UN, and there's always different degrees of commitments. No, the Europeans might be very tough, and others in the United Nations might actually undercut a sanctions regime that they have underwritten. No, and so that turns out in this analysis as well. Now, let me conclude here. First of all, we think it's important to have these leads and lags in the analysis, because otherwise we don't estimate the contemporaneous effects correctly. We see evidence for a sluggish recovery, which means that the welfare costs of sanctions are bigger than we may think, because once they are lifted, the damage is still there. It needs time to rebuild trust and rebuild the relationship. We also see that in the course of a sanctions regime, as you add more years under sanctions, the trade destruction becomes heavier and heavier and heavier. That does not contradict literature by Disagi and van Bergijk, for example, who say that countries learn to live with sanctions regimes. So Russia maybe has learned to live with a sanctions regime, but that's happening elsewhere. That's happening not in the bilateral relationship that's sanctioned. It happens with other bilateral relationships, or it happens with its interior or domestic trade. We have shown that longer sanctions regimes do more damage than shorter-lived ones. We have some weak evidence that you might, if you recover, you might go to a level that's higher than before the crisis broke out. Now, I have a third item on my slides here, but time's over. Let me just show you, or do some advertising here very quickly, but just show you this picture here, because I wanted to have Finland on somewhere in my talk. And what you see here is another paper where we tried to actually do the welfare analysis of sanctions, and do that for a different time period. So it's not covering 1950s to today. This is the current sanction regimes. And the degree of redness here tells you how much a country is actually seeing its welfare reduced. So this is simulations from a trade model. And what you see, Finland here has a welfare cost of 1.1% out of essentially the sanctions against Russia. There's also Iran sanctions in here. They matter too, but not that much. So the Iran sanction regime is about worth 1% of Finnish GDP. And the interesting observation is that across the Atlantic, where our allies push very much for sanctions, the economic cost of these sanctions is essentially zero. You know, that's an interesting insight. And for me as an Austrian and formerly working in Germany, it's also interesting to see that the economic cost of sanctions in a country like Germany is important. And if you add it to military spending, if we really believe into this, in the book title that I showed before, war by other means. Now, if this is the other means, then that is part of a war effort, not such a lethal war effort, fortunately, but still. And if you add that, more countries in Europe pass the 2% threshold than if you just look at military expenditures. Well, with that little anecdote, half taken serious, I'd like to finish and thank you for having me, and thanks for your attention.
Okay, thank you very much. And we'll move now directly to the next presentation, and then we have the Q&A after Nauro's discussion. So, senior advisor Zuzana Fungachova from BOFIT has a long career in writing about financial sectors, banks in emerging markets, especially China and Russia. And the current presentation is on banking and politics in Russia.
Thank you, Ika. Okay, I have to learn how to use this first. Okay, so good afternoon, and it's my great pleasure to present part of the current research agenda of BOFIT here. And the topic of my presentation is, as Ika said, banking and politics in Russia. So I will present two recent papers that I've been working on with my colleague Laura Solanko from BOFIT, and then other co-authors from outside. But let me start first very general So on banking and politics, because what we have seen in the recent decades is that there has been increasing interest in studying the interplay between banking and politics. And in this literature, the key idea is that politicians might have some incentives to interfere in banking. Why? Well, the first reason might be that, maybe the most important one, is that they want to increase their chances of re-elections. But also another reason might be that they do it to reduce potential threat of social instability. So then the question is, why banking really matters for politics? And here there are two main reasons. The first one is related to the very well-known literature on finance and growth, meaning, this literature tells us that higher bank lending contributes to economic growth. So in fact, bank lending then affects economic growth. The second reason why banking matters for politics is the fact that financial stability matters for political survival. So if you imagine if we don't have financial stability, meaning we have some bank failures or some banking crises, these are generating some economic costs, and of course this is not very good for the political survival. So then more specifically on elections and banking, actually this literature is based on the literature on political cycles that is not very recent, but this literature basically tells us that the usage of macroeconomic instruments can be, in some cases, influenced by political motives. So what does it mean? It means that the main motive of using these instruments is not just maximizing social welfare. And this then leads to political business cycles. And originally, this literature focuses on monetary and fiscal policies, but of course, when we think about the governments, they can also use some other tools to gain electoral advantage. And in these some other tools, there might be the banking industry. So that's why elections can contribute to banking cycles. And the two main channels through which elections generate banking cycles are bank credit and bank failures. And actually these two main channels are the main topics of the two papers that I'm going to briefly present to you. So the first one is on bank lending, so bank credit, and it is already a BOFIT discussion paper, and it is entitled Political Cycles and Bank Lending in Russia. And here the co-authors, in addition to my colleague Laura, there are other two co-authors, Koen Skors from Ghent University and Laurent Weil from University of Strasbourg. So when we look at the literature on elections and bank lending, this literature provides evidence that indeed political influence is used to expand credit because the objective is to secure votes. And as you can see on this slide, this literature is quite broad. And it concerns both emerging markets and developed markets. I just want to say that the first paper, or kind of seminal paper, is the Dinch 2005 paper that is first mentioned here. And what he shows in this paper, that really the lending by state-owned banks in emerging markets is increasing in the years, in the election years relative to private banks. So this is a cross-country study on 36 emerging markets. And this is kind of the first one in the literature, which has been then followed by studies on different countries. As you can see, by there is evidence for India, for Brazil. Also, there is an evidence here by my co-authors, Koen and Laurent, on Russia. And this, they study how Vladimir Putin came to power in 2000, and they show that corporate loans were really used to incentivize employers to influence voting behavior of their employees. And then there is some evidence for Turkey as well. But what is interesting in this literature is the fact that it doesn't concern only emerging markets, but also developed markets. And in this literature, there are several papers on Germany, actually, because German saving banks are very specific, and they are shown, for example, in the paper that I mentioned here, that they adjust lending policies in response to local electoral cycles. And then there is some more recent evidence from France as well, where they also find a kind of reward for the banks. This reward is the access to the market of loans to local public entities. So this literature actually, as you have seen, provides evidence of electoral credit cycles. The important thing is here to see what kind of instruments are used by authorities to influence bank credit. And based on this literature review that I provided, the most important instrument here are the state-owned banks. Because if they are really state-owned, then the government can easily use these state-owned banks and pursue its own interests. But also, these might be some other banks. So these are the banks where the supervisory board chairman is a politician. And this is exactly the case of Germany. So instruments is the first thing, but then there are also, what is important are the economic costs of political interference in lending. And here, the idea is that when we see some credit booms before elections, then following the credit boom, you would expect also the economic growth. But in the end, when we look at the data, we don't see that these credit booms would be affecting investment or output. So basically, this leads to not efficient allocation of credit, and then this can influence the economic growth in the long run. And then, of course, if the banks are providing loans to more risky customers, their financial situation can also worsen. And this is what we are also looking at in our research. And until now, I have been talking mostly about the state-owned banks. But then the question is, what is the role of private banks here? Is there any role? So we show in our research that maybe it is important, especially in electoral autocracies. So in this kind of regimes that are different from democracies, and since they have, in democracies, you have fewer opportunities to influence elections by pressuring on private banks. But then maybe in electoral autocracies, the pressure can be extended also on the private banks. This is a new kind of aspect that we are bringing to the literature. So we are working on Russia. This is not a big surprise, being at BOFIT. But why Russia is a good case for our studies? When we are hearing the questions about the possible interventions in the electoral process in Russia, nobody is wondering, nobody is considering it kind of strange. And indeed, it has been shown in the literature that there are some interventions to guarantee the electoral outcome, and there are several channels how this is done. So there might be different channels. Here I mention the most important ones that were confirmed in the literature. So one is media control, then electoral fraud, then the workplace mobilization, or the use of state-owned banks. So all of this provides us with the indication that really in Russia the authorities might have interest in shaping the election outcomes. And now what do we do in our research? The main question that we are studying is, or we are asking, is whether banks in Russia are increasing their lending before presidential elections. So this is not a new question in the literature, but we use Russia because we have because there is this pressure on there are these incentives on influencing elections, And also, we have very nice data set, which has the detailed monthly data on individual Russian banks. So the studies that I have mentioned before, these were the studies that were used, that were using mostly yearly or quarterly data. But with our monthly data, we can really track very clearly what is happening 1 month, 2 months, 3 months before elections. So this is very important. And also what we do in addition, kind of new, is that we examine if the elections in Russia are followed by increase of bad loans. So these are the economic costs that I have mentioned. And we consider the time period between 2004 and 2019, so it's quite nice data set, where we have 4 presidential elections. So I have to stress we are considering presidential elections since these are the most important ones in Russia. So the methodology here is very standard, and we are estimating the panel regression, where the dependent variable is the loan growth. So we are explaining the loan growth of bank I at time t. And we have a set of variables that are explaining this growth that are very standard in the literature, like bank-specific variables, then some macroeconomic variables. But the most important variable for us is the election variable. So we call it election dummy. And this dummy equals to 1 for the months before elections. So it equals to 1 in March 2004, 8, 12, and 18. So this was the time of the elections. And then we have 7 other different specifications of this election dummy, depending on how much before election the dummy is equal to 1. So it can be 1 month before, 2 months before, and so on. And we have very standard bank and time fixed effects included here. We also check if the state-owned banks in Russia are behaving differently from the other banks. So here I provide the main results. I only report the estimated coefficients for the variables that are of interest for us. As you can see, we have 8 different columns here. And in each column, the election dummy is defined differently. So if we take the first column, then election dummy is equal to 1 for the month of elections. So this is March. And then in the column 2, correspondingly, the election dummy is equal to 1 month before elections, February, and so on. So what can we see here? First, the estimated coefficients for the election dummy that we can see in the first row. They are telling us, as you can see, 7 out of 8 of these coefficients are positive and significant. So this is telling us that the lending of banks in Russia increases before elections. So really we can see this interplay of politics and banking. This is not surprising. This is in line with the previous studies. But then when we look at the third line, we have the result where we have the interaction between elections and state-owned. We can see only some of the coefficients significant. So basically, we don't find a robust result that state-owned banks would behave differently from other banks before elections. And this is an interesting result because if you remember what I told you before, in previous studies, it was shown that in other countries, state-owned banks are behaving differently. But here we can see that all the banks in Russia are behaving in a similar way before elections. So all of them are increasing their lending. And our explanation for this is that most probably this is related to the fact that Russia is not a democracy, but electoral autocracy. And in this kind of system, it works differently. Then we are looking at the bad loan growth after elections. So really, if the increase of lending that we see before elections is drawn by economic factors, then there would be no reason for an increase in bad loans after elections. So this is what we are checking by running regressions, one where we see the increase of bad loans 1 year after the elections. And here, as you might notice, we have much less observations because these are yearly data that we are using here. And we are using two dependent variables, different definition of bad loans. But for both of them, you can see in the first line, the estimated coefficient for the elections is significant and positive, which means that there is significant increase of bad loans following elections for all banks. And when we look at the interaction of elections and state-owned banks, we don't see significant results. So here again, the state-owned banks are not behaving differently. Also, we are looking or we are investigating if this pre-election increase in bank lending that we find is focused on certain type of lending or banks. And here we are also kind of bringing new things to the literature because we are able, with our data, for example, to distinguish between firm and household loans. And maybe, given the previous literature on Russia, one would expect that the firm loans would be the driving force. But when we check this, we don't find significant difference between firm and household loans. So meaning that both firms and household loans are increasing before elections. Then it might be that if there is some pressure on this lending before elections, then higher loan growth would be observed for the banks that are most involved in banking. So if there is some pressure, you would maybe put it on the banks that are most important, meaning the biggest banks or the banks that have the higher loan-to-asset ratio. And this is really the case. Also, there is some hypothesis that maybe the banks that have weak fundamentals would behave differently before elections because they want to prevent a license withdrawal by the authorities. So they would kind of like to buy implicit protection. So that's why we are investigating these banks with weak fundamentals, but we don't find that they would behave differently before elections. So let me summarize the main findings. So what we find is that all Russian banks tend to lend more before elections. So this is different from literature where there is only the state-owned banks. Then this increase in lending is not associated with economic expansion because we are controlling for macroeconomic factors. And also we find that there are more bad loans 1 year after elections. And as I have mentioned before, this increase for different types of banks and loans supports political motives because we can see that the lending increases for both firm and household loans, and it increases more for banks that are more involved in lending. So basically, we do not find any economic rationale for increasing lending before elections, and that's why we conclude that there is possibly this is possibly influenced by political motivations. And of course, we believe that our work contributes to understanding the interplay between politics and banking in a non-democratic regime, because the literature before has been focused on democracies. So where the increase in lending is not restricted to the influence of state-owned banks, but also private banks can be influenced. But of course, we need more research on this because we need to establish better the mechanisms and economic structures that are shaping these political lending cycles in non-democracies. So this was the bank credit part of my presentation. As I have mentioned, there are two main channels through which elections generate banking cycles. So bank credit we have gone through, and now very briefly I will mention our second research on bank failures. So this research is entitled The Politics of Bank Failures in Russia, and here we have another co-author, Alexei Karas, as well with us. So basically, when we think about bank failures, the bank failure situation might be negatively perceived by the voters, and the politicians are aware of that. So there are some political costs of bank failure. So these are not the direct costs to the shareholders of the banks, but also to taxpayers. So then this indicates that there is some negative signal of the skills of the government to the voters, and this is not good. But also bank failures have negative impact on credit supply, because of course if banks are falling, then there are less banks providing loans, and the credit supply might decrease. So for these reasons, governments might have incentives to have less failures before elections. And when we look at the literature, there is already some evidence here on emerging countries, and this is a cross-country study, but it has been done only until 2000 and only with about 20 countries, and then some evidence for the US as well. But in our research, we are looking at Russia, and in a similar manner as in the previous paper, we examine if bank failure probability decreases in the months preceding the presidential elections in Russia. And here we use a standard logic model that is explaining the occurrence of failures. So basically the idea is that when in this model we are controlling for the bank level and macroeconomic variables, then we would expect that there is no statistical relationship between electoral cycle and bank's license withdrawal. If we find this kind of relationship, then it means that there is some political influence here. So why Russia? Well, Russia in this case is very nice because unlike other countries, we have enough bank failures to study bank failures. So there has been a large number of bank failures, which in our case are defined as license withdrawals in the last 2 decades. And again, we consider similar time period as in the previous paper, a little bit longer actually, but because we want to have 2 years before and after the first and last elections. And we have great data on license withdrawals from the official source, Central Bank of Russia, and these are at the daily basis. So this is communicated by the Central Bank of Russia. So here we have very nice data. Unbalanced panel of over 192,000 bank month observations for over 1,400 banks, and during this period, over 700 bank failures. So this picture illustrates the idea of our paper, because this figure shows the number of failures by periods of 3 months. So you have in 3 months, December to February 2004, you can see how many bank failures there were, and then the March, May 2004, and so on. And then you can see the solid vertical line. These are the elections. So just by looking at this graph, you can see that there is some pattern that before elections we can really see that there are less bank failures. So methodology here, I have mentioned the logic model. So the dependent variable is a dummy variable that equals to 1 for the month of license withdrawal. And then again, we have the election dummy. Here we have 4 different windows for election dummy: 1 month before election, 3 months, 6 months, and 12 months. And then the standard bank controls and macro controls. So here are the main results, and there are 4 specifications based on the definition of the election dummy, and we can see that we have all the 4 coefficients negative and significant, which means that the bank failures are really less likely in the months leading up to a presidential election. And also look at the magnitudes, because we can see that 1 month before elections, the magnitudes of this is even higher than in the 3 months, 6 months, or 12 months. So then we do some additional estimations I very quickly mention. What is interesting for us is to look at the longer time period. So basically here we would consider the time period from 91 to 2020. So here we don't have all the bank specific variables, but we can use the bank fixed effects. And we would look at the election dummy, how it behaves. And what we find is that election is significantly negative for estimations in the Putin era, so starting from 2002. This is what we found in the main estimations, but it is different, it is positive in pre-Putin era. So basically this indicates that delaying bank failures seems to start only before the elections in 2002. And then we are also explaining the number of bank failures. So in this case, the dependent variable is the number of failures, and Again, we don't have bank level information here, but we have the advantage of having this number of failures at a daily basis. And here again, the election dummy is significantly negative, which confirms our main result. And what happens after elections? Well, after elections, if we see less failures before elections, then maybe there would be kind of catch up after elections. Or maybe there would be nothing special happening after elections because all this period around elections is very special. So what we do, we check what's happening 1 month, 2 months, 3 months, 6 and 12 months after elections. And what is interesting is that we don't find any significant results. So there is no catching up taking place after the elections in the bank failures. So to conclude, we provide here the evidence on the existence of political cycles in bank failures in Russia, and this is really supported by different types of estimations. And just to quickly summarize what I've been talking about, so basically there are the both channels through which elections generate banking cycles. I have mentioned the bank credit and the bank failures. We show that they are present in Russia. So in bank credit channel, we see that the state-owned banks as well as private banks tend to lend more before presidential elections. And for bank failures, the bank's license withdrawals are less likely in the months leading up to a presidential election in Russia. So this is all I have. Thank you very much for your attention. I'm looking forward to the comments of Nauro.
Okay, thank you very much. And now Nauro Campos from University College London will discuss both papers. So he has written extensively on political economy, broadly defined, European integration, and we have actually even co-authored a paper on this. But please, Nauro, go ahead.
Well, all right, excellent. Thank you very much. Let me just start by once again saying happy birthday to BOFIT. It's a real pleasure to be here today. I mean, it's an honor to come back and be part of this this commemoration. And in general, and more specifically, thank you very much for the opportunity to read this two very, very interesting papers. I mean, I learned quite a bit from them. I hope they'll be made available afterwards so that everybody else also have access to them. They're really two superb pieces of research, and I think the choice of papers also is very informative about the type of institutions that BOFIT is. I doubt that there are many other central banks in the Eurozone in which you see a paper on sanctions and another one about autocracies and naming names them. I think this is this BOFIT attitude is also shows in the selection of these two papers. I will comment on the sanctions and the lending paper. That's how I'm going to be referring to them. Then the first one, the full name and full authorship. In red is the sanctions paper, timing the impact of sanctions on trade, and the lending paper is political cycles and bank lending in Russia. And my overall opinion about the papers, I think they are two really excellent papers. I mean, very, very well written on two absolutely important topics. And I did really learn a lot from each of them. I have an overall opinion, and I also have an overall comment, common comment, which I'm incredibly pleased with myself because I thought that was the real kind of max efficiency that I can get. So you got one really great comment on the two papers on one slide. Then I don't know what your plans for dinner or lunch. Yeah, I'm raising expectations, as you can see. I'll keep, is there a drum roll sound effect there? But I don't know what your plans for dinner is, but I would stop everything. And because none of you cited this thing, and there is a paper, then what I think you should do is, after this presentation, you two, and Laura, because Laura is also here, you sit in that room there and talk about this paper that you should write that combines the two papers. Because Stephen Ongena and two other guys. I mean, none of you cite this paper. Wrote this intersection of the things you're doing. I don't know Mamonov and Pestova. I'm sure they are fine economists, but I know Steve very well. I think it's going to be very, very difficult to improve upon what he did. I haven't read the paper. There's a VoxU column. Then before you meet in that room, before dinner, and decide the joint paper that you're going to write, you can read the VoxU column. I know Steve very, very, very well, and I think it's going to be very, very difficult for you to come up with an improvement on what he did. However, I mean, he doesn't have your data set and the banking data set, and he doesn't have the sanctions data set. Then if anybody can improve upon this, it's you. Now, this is my one comment, and now I could have stopped it here because I'm very pleased with myself. I'm sorry if it shows. I think it's a great comment. But and I still have 18 minutes, I presume. Then I'll fill it in with comments on each one of the two papers. Okay, I'll talk about the sanctions first. Overall, I mean, it's a very, very engaging research question. The econometric approach is world-class. I mean, very, very solid. Data set, I mean, really amazing, incredible data set. And very, very insightful findings. I mean, let me kind of put some flesh on this storm of adjectives. The first one, I mean, what is the research question? Do sanctions work? I mean, it's a great question. I mean, and what the paper does is qualify this. It's like, okay, once you take into account timing effects, do sanctions work? I mean, and the answer is surprising and really, really interesting. The econometric approach, I mean, I'm not going to bother you with this, but I mean, we're talking about two of the leading researchers on this field. I mean, I don't know the other four. I have too many co-authors, but Gabriel and Yoto, I mean, really massive names in this area. Then, this is really frontier, state of the art. The data set is the data set they are using. I mean, as you could see from the presentation, is absolutely interesting. And, the findings there, sanctions do work. And, I mean, we know, not me, or I learned from you, how to make them work better, which, from a policy standpoint, I mean, it's amazing. It's really, really good. What do? I mean, they use this data set all the way back to 1950. I mean, it covers, everything. I mean, it's really, really comprehensive. Use the structural gravity model, and essentially bringing leads and lags. I mean, we've been talking about kind of computational issues over lunch. I mean, that's a very exciting lunch, as you can imagine. But I mean, it sounds trivial, but if anybody ever run these beasts, I mean, to bring in leads and lags is a nightmare. I mean, it can be very, very computationally costly. And, the type of insights you get out of this they are really, really worthwhile. Then what did they find? I mean, the main find is that and I'm discussing the paper, not the presentations, by the way. They find that sanctions are 17% more effective when you take into account the timing. Lags matter in the sense of the threat of sanctions. I mean, this is a very important component of sanctions design. The impact lasts for 7 to 8 years, and the longest sanctions are more effective, and the Americans do it better. They apparently do a number of things better, but they also do sanctions better than vis-a-vis the EU or the UN. Okay, let me, after give you some comments, more constructive ones. The first one, the data set, right? I mean, and I'm talking about the paper, not about the other papers, because you both have too many other papers. Then, I only kind of concentrate my comments on this one. Is this the most complete sanctions database? Is it unique? There's no competition? Then write it down, right? Say so. You see, I mean, if there are other companies or other data sets, how does this one compare? It would be nice. I mean, I'm sure this is much better than whatever else exists, but I mean, just exploit this a bit more and use this to motivate the work. The second thing is the main finding, right? I mean, the main finding is that sanctions, once you account for timing, is 17%. But I mean, 70% of what, right? I found, I don't know anything about sanctions, and I found on page 18, you present the estimate without taking into account timing, and you write down that sanctions reduce trade by 76.8%. I mean, I even wrote whopping there, right? Because I mean that's the technical term. I mean that's massive, right? I mean there are COVID vaccines that are much less effective than this, and we are all here. Right? I mean, this is a massive, massive number. If I'm writing this paper, this 76.8 is in the abstract. Is 3 times in the introduction, and I'm thinking about putting it in the title, right? Because this is big, big effect, very, very big, I think, right? And you're looking at me and say, okay, well, we got it bigger. It's not 76.8. What are you talking about? It's 82. I said, well, they're right, 82, right? I mean, this is big, right? And this it should be kind of highlighted. Okay, then a couple of more comments. It would be nice to have more clarity on the duration. You see what exactly is the T in the econometrics? I mean, is it the first year the sanctions are announced, first year they are implemented? Is it mid-year, the first year they are lifted? I really do not think, it has not crossed my mind the suspicion that this will change any result. But I mean, I think that the clarity on that will be helpful. And this is, I mean, really a minor thing, but it's one of those. I mean, on the discussion of leads and lags, because it's so important in this paper. I thought that there is a little bit of a mismatch between the table and the text. I mean, sometimes we update the tables and forget the text, and we update the text and forget the tables. I'll double check, especially at the tails, because I thought that was a little bit of a mismatch. And you have a lot of other papers. Then I will give you 5 policy suggestions. I mean, I have no kind of academic comment, as you can tell, right? I mean, I'm not asking you to test jointly the legs that I could, but I'm not, because this is a completely policy discussion. Then I'm not going to write that down. I have a few suggestions from what I learned. I thought you made a very good point, that we are very defensive about sanctions, right? And we shouldn't. Right? We just shouldn't, right? There may be, call them temporarily raising barriers to trade, right? That would move the dial, right? This is a fundamental policy tool, right? I mean, you deviate from a previous agreement, right? You have to be punished, right? I mean, this is part of the agreement. Right? I mean, maybe, the diplomats and the political scientists and the philosophers, they think we should be, nice, right? But, life is not nice, right? We have to deal with this, right? I mean, you deviate, you're punished. That's it, right? You deviate, there is a cost. And, somebody is going to collect the cost. The second thing that I think, you mentioned a little bit. Actually, I didn't know you've done it, but how costly and effective these sanctions are in terms of income or in terms of productivity. I'm thinking about the FAIRA AJ 2019 paper, which has, as you know well, has been used widely in the Brexit debate and could be helpful here. But you have some estimates already. And you can refer in this paper to those estimates. I think that would really, good marketing, right? I have another paper that does this, right, and reinforces the fact that this is an important tool. I'll test also whether Americans do it better, but are Europeans doing it better over time? Are they learning? Are they improving how they design and implement sanctions? I think that is an interesting question. I mean, if you want to talk to Brussels, for example. The other thing I thought would be kind of useful here is, a handful of dollars is the Clint Eastwood, a handful of case studies. You see, kind of just to put more meat, right? I mean, every sanction is, unique. Well, there are synthetic counterfactuals, I've been told. There's a popular approach or even studies. And that would enrich, I think, the analysis. And the last one, this is your data, right, which is great. you're talking about trade sanctions, right? But there are, I mean, using your data set, I mean, a number of different types of sanctions. And I'm very interested, I mean, for the joint paper that maybe I hope you write, you have financial sanctions here, and in particularly how they interact with trade. I think it would be nice to do. Okay, let me talk a little bit about the the landing paper, okay? The landing paper overall, I mean, it's, the research question is absolutely important. I mean, the data set is really very, very rich, very, very unique. And the findings are, I mean, as you saw from Susanna's presentation, they're great. I mean, the question is the following. I mean, do electoral autocracies use the financial system for political ends? I mean, differently, actually, from dictatorships and from democracies. Then this is a very, very interesting question. The data set is the universe of Russian banks. I mean, it's everybody, everything, monthly since 2000 and something. Then it's a very, very big and very detailed, very rich data set. And the findings from the landing paper is that, you know, it's not just the private banks, public banks do increase lending ahead of presidential elections, but private ones do. And that is completely different from the rest of the literature. Okay? Then what do I think they did? I mean, use monthly data for all Russian banks since 2004, 2003. It's a huge data set, 130,000 observations. And combine that with the 4 presidential elections in Russia since 2000. There was one in 2000, 2004, 8, 12, 18. And they find, basically, that there's no difference between public and private banks. More specifically, contrary to the literature, state and private banks lend more before elections. There is a surge of pre-election lending that is followed by a rise in bad loans, by deterioration of loan quality. The surge, this is a no result, but it's crucial in this story. The surge is not driven by higher growth prospects or positive economic shocks. And find that, why do the private banks lend more before election? Because they're going to get, the benefit is more government deposits after the elections. Okay? Let me give you some comments too, but the same mode. They're not harsh, I know, sorry. The first one is economic significance. I mean, there's no discussion in the paper whatsoever about the significance of the effect. And I would like to hear kind of something about that. I mean, how big is this effect? Okay, they increase lending, but I mean, is it 1%, 2%, 15%, 340%? What is it, right? How big is this thing? How costly it is, right? I mean, does this kind of really shakes the Russian financial system? Does it shake the European system? I mean, well, how relevant is this? And one way of tackling these two questions is how does it compare to all these other papers you mentioned? I mean, the Germany, Turkey, Brazil, and the other cross-country ones, right? I mean, then comparing the size would be good. Similar question from the previous paper, by the way. I mean, does the effect change over time, right? I mean, these are 20 years. Does the government learn anything, right? I mean, if you want to manipulate elections, I mean, are you getting good at it, or you're getting more violent? I mean, what are you doing, right? I mean, is the government better in 2018 than in 2004? And this is kind of I think a nice suggestion in terms of methodology if you want to pool. This is Hoven is the first author. I know there's Shapiro, which is author number 3, but it's a very useful paper for, I mean, if you want to do that, I think. The other 2 very harsh comments. What about the 2000 election? I know that you have some data that goes into 2002, but there's nothing talked about. What about parliamentary and regional elections? I mean, is it possible to exploit this data set at the regional level and see whether or not the surge is also observed at that level? The last kind of very harsh comment is the one I'm quite interested about. I mean, because the paper tells us why banks go along, and the argument is nicely told, very convincing. But how does the government make these banks go along, right? I mean, I don't know. I mean, and I really, do they send an email? Do they call? I mean, do they send a horse's head? I mean, what do they do, right? I mean, no, seriously. I mean, how is this done, right? I mean, this is. And I don't know if you know Kuhn, but I'm sure one of the co-authors is the perfect person to do this, right? Because Kuhn has written his PhD dissertation, right? He's a very tall Dutch guy, Belgian guy, and he pretended. He did a business card this is how crazy he is. Early 90s, Moscow, a business card pretending he was a banker, and then he went through all the Russian banks asking for balance data. And that's how he wrote his dissertation. And he's the perfect guy to find out how this is done, because, I mean, I think it's an interesting question. I mean, I'm not a banker, but anyway. I have a few suggestions on the landing paper, because the failings paper is 1 minute. Yeah, I have 2 slides. The failings paper is forthcoming. I mean, right? I mean, this comments about the landing paper that, I mean, if you look at the landing paper, they are all natural ones, right? Introduction, add a paragraph on the findings, because, I mean, it's not there, right? Section 2 on the Russian financial system, tell the reader, I mean, how big this thing is, add the references and the tables to make it more accessible to people who don't know about the Russian financial system, right? I think I was kind of wanted more of that. It's a great data set. It should be described in more than 1 page, right? I would extend that too and provide some justification for the random effect. And this is the kind of the harsher one, maybe. I mean, I don't think this will change the results, but I was quite curious about why is January? I mean, when January is usually not significant, and when January is significant, nothing else is. I don't know what it is, right? I thought, I mean, maybe there's a reason. I mean, so what is it? I mean, Putin goes somewhere in January? I mean, I don't know. I mean, but there must be a reason for that. It's like, if you know, write it down, because I think, or kind of put January in the appendix. Okay, thank you so much, there. Kiitos again, and I've been told by Google Translator that this means happy birthday, BOFIT.
Thank you very much. Nauro, we have a few minutes, so I would ask the paper presenters to reply. I mean, not to everything, obviously. But before you do that, there are some questions in the chat. So for Gabriel, there's a question from Risto Herrala. Can you see something in the data about the circumvention of sanctions via third countries? So basically, does the trade with other countries go up as the bilateral trade goes down? And then for Susanna, Martynas Basilius from EU delegation to Russia, can you explain that no catch-up in bank failures after the elections? Is there some reason for this? But now let's go in the same order. So Gabriel, first.
Yeah, thank you very much. Thank you now for a really nice, very harsh, of course, but still very nice set of suggestions and comments. All very well taken. I have no word to contradict you. Certainly not in that first part of your comments. We're so positive, and then also those harsh comments are very good ones. So yes, how defensive should we be about sanctions? I mean, I agree with you that implicit sanctions are there to make agreements stick if we have no official enforcement mechanism other than that. Now we have no world government, we don't have that. But of course, when we observe sanctions, it is a sign of failure, right? So the threats have obviously not worked, right? But then, of course, it's part of the game. We quickly can have trembling hand situations where you make a mistake, and then then we need this. We need the sanctions to be there, and we need it to be bloody effective, because otherwise, threatening sanctions for the one time we impose them, and you don't observe any blood, then they lose their bite, and then all our international agreements, from WTO law, of course, where we have specific sanctions regimes, not in actually these. We're not talking about WTO sanctions here, but human rights, the Universal Declaration of Human Rights, or international law in all its aspects. If once we impose sanctions are not effective, we are done. Then you could do what you want. And in that sense, this is a very interesting question. Maybe we should elaborate a little bit more on that. Have a look at the Jim's paper in the AHE. We do have. I mean, I gave you this glimpse on that other paper where we do simulate the cost, because we can take structural gravity to exactly the general equilibrium framework that generated the equation that we estimate. And we have done so in a couple of papers already, and we did it with the Kiel model for the picture I showed, but that is certainly interesting. The learning question is a great one that deserves maybe a paper, and maybe we should do the paper together, because they had the same suggestion there and there. So how is this political machinery evolving over time? My impression is they're not learning, but well, they could be tested. Case studies, yes, that is always something where there are a lot of stories that you could tell, but we're interested in discovering the general patterns and averages. There could always be more, and then once you have them in, you say, oh, but that diverts attention, and people think it's an Iran paper, or it's a Russia paper, or it's a Cuba paper, while we are, but these episodes do drive the results. I mean, it is the big sanction episodes that all talk about that do matter for what we find. And look, and yes, and then the data set is big. It's too big. We were working with a big team now, as you've seen. But we could. There's so much that could be done, and bringing the financial sanctions part of the data set to fruition would be very interesting for sure. So that's a little bit where my and Joto's experience ends. No, we're not doing any finance in our own research. Now, in the chat, the question was whether we know something about circumvention of sanctions, and yes, we do. Of course, there are sanctions that are not multilateral in essence, that are plurilateral or unilateral, and then we don't need any explicit circumvention. It's just happening as a general equilibrium thing. We have, when we do trade agreements, we see trade diversion, right, from those countries not included in the agreement. If we impose new trade costs, as now was suggested to frame sanctions, temporarily impose trade costs, then this does the same. It also diverts trade, and but with a different sign, of course. And that's what we do observe. We do see in general equilibrium that when a pair has sanctions going, then each member to this pair trades more with the other countries. That's a general equilibrium thing, and we would say that should happen in a trade model with many countries. But the more interesting question is whether whether in a multilateral regime where many countries actually do the sanctioning, the trade destruction is the same everywhere, and it's not. We see a lot of heterogeneity there. We have a paper, I think it's in the Review of World Economy or so forth coming, where we measure that enormous amount of heterogeneity. Plus, we also see that even if the treatment is the same, in a trade model with many sectors and many countries, the economic costs can be very different. So you could see that the trade of, let's say, Slovakia with Russia and the trade of Finland with Russia is going down by the same amount since 2014 due to the Russian sanctions, but the costs that this has for Slovakia are much bigger than for other countries. In that sense, you could say, well, you guys, you talk a lot about sanctions, you like them, like the Americans do that often, knows that please Europeans join us in our sanction regime. And then we know, yes, trade is destroyed by the same amount, everyone loses 40% or 80% or so, but the American trade is much smaller maybe, or it has a much smaller value-added content, so that the pain in the United States is much lower than it is with other partners. We don't call this circumvention, but it has a little bit the same flavor, that the same regime, the multilateral regime is there, but not everyone bears the same costs. But thanks for all the great suggestions, and makes me eager to get my fingers into the data again. Thank you.
Okay, thank you very much as well for the nice comments, and also this idea of the joint paper. Of course, we can discuss that. I would be happy. For the comments, so if the effect changes over time, well, basically what we did, so the estimations where we excluded one elections at the time, and the effect was there. It's not maybe completely this, but maybe we can try to look into this more. I don't think, like in Russia, it's maybe about the political situation and the popularity of Putin that maybe is important here. Even if our data set is really great, the problem is that this data is the financial data of the banks, and we don't have the regional aspect there. So if we want to go regional, then we would need to use the aggregate data on lending by regions, but then we cannot distinguish between state-owned banks and private banks. So there are some things that maybe can be done at the regional level, but not with this dataset, unfortunately. For the parliamentary elections, yes, actually we have done this, and it works as well. It's just not in this current version, the version of the paper that you had. So it's good, it works. How does the government make them? Well, that's a good question. And I think, to elaborate on this, you need to know more about Russia. Of course, it's not like somebody calls you and that you have to lend more. So it's like people know what they are supposed to do, and the banks know what they are supposed to do. And for us as researchers, it's very difficult to provide a clear evidence on this. So maybe, or for sure, we have been discussing this a lot with the co-authors, how to put this to the paper, but it's not easy actually. So, well, January, especially in Russia, but because, the half of the January are the holidays, but, even when we control for this, we have this very special thing there, and actually, we were wondering the same what you did. So we will see if we find some good answer to this. But this just confirms that you were reading our paper very carefully, that you noticed this. So that's very nice. Thank you. That was a test. Yeah. And for the question from the chat, no catch-up after the elections. Well, we were checking 1 year after the elections and the bank failures, and over there we really don't find significant results. As I have mentioned, this might be the kind of special time around the elections, so not only before but after elections. We are still working on the paper, and maybe we need to check kind of the whole election cycle and see how it develops then later than 1 year after elections, but then it's difficult to say that if it's really the catch-up at that point. So I think, yeah. And about Kuhn, I completely agree. He is a great researcher on Russia.
But he should find out how they...
Well, you see, yeah, this is what we were discussing a lot. Yeah, it's his job. I will, of course, tell this to him if he doesn't listen to us now. So, thank you very much.
Okay, thank you very much. I think the time has more or less run out. It seems that we could continue, and perhaps we'll continue the discussion later on. But the conference proper is about to end. And just some housekeeping issues still. Recording of this plus the presentation should be on the website, I think, by tomorrow at some point. So you can rewatch or watch the first time the presentations. I'd like to thank, of course, all the panelists, paper presenters, discussant for excellent content for the program. The audience here in Helsinki, it seems that a few people have sort of slipped out during the day or during the afternoon, but that often happens. And then, of course, the online audience. I think in the morning we had more than 300 people watching, which is, I think, is fairly respectable audience. Then special thanks to people who actually made this possible. So we had Lisa Mannila as an event coordinator in the spring. So she actually booked this room and sort of set things in motion. Then, unfortunately, she retired, but then Riikka Virtanen, her successor, took the baton, and as you can see, everything has gone flawlessly, so thank you very much for all. And then I would like to sort of just end by thanking, of course, all my BOFIT colleagues for intellectually stimulating and always interesting environment. I think one of the sort of key lessons for a successful leader is that hire people who are smarter than you and things are easy. And I can see that this really holds true. And finally, Erik already mentioned that my predecessor, Pekka Sutela, deserves a special mention. I think without him, we would not be here today. So it's unfortunate that he cannot be with us. But on that note, now it's time for a drink or dinner, whatever you want. And we'll see what the fourth decade of BOFIT will bring. Thank you.